Hello guys, welcome back to the Financial Academy YouTube channel. Welcome back once again to my YouTube channel. So if you are seeing me for the first time, my name is the Financial Academy. I create content on the forex trading, the stock trading, and the cryptocurrency trading. So if this is what you like, make sure to hit the thumbs up button, like this video, subscribe to my YouTube channel, and also comment down below if you have any single question concerning any of my single video. So without any further ado and without wasting much of our time, let me now dive now straight today into the second edition of my full forex trading course, because I have already created the first set, which is 5 hours course. I want to finish the remaining 5 hours, which is 10 hours. So this second video will be my second edition of my full forex tutorial course from the beginning to the end. So please make sure, if you haven't watched the first edition, go check it out. It is a 5-hour long video before you can watch this one, or you can watch this one and also watch the other one, so that you can be able to understand everything that I have been teaching from the first edition. So please make sure to watch this video from the beginning to the end if you want to understand everything concerning the trading psychology, concerning the risk management, and every other thing concerning discipline and patience in forex trading, and every other thing. After that, this video is for you. So right now, I will be diving straight to my screen. When I dive straight to my screen, then I will be displaying and showing everything for you in my screen. So please follow me right now. Let's head over to my screen. Make sure to watch this video and don't skip in any of these videos, so that you don't skip in any of the language, understand, and any of the knowledge that I will be displaying on this channel. So follow me right now. Let's go to my screen right now. Let's go.
Hello guys, welcome back once again to the episode 6. So let's continue from when we stop on our episode 6. So this episode 6 is talking on everything concerning fundamental analysis, the complete guide for traders. So in this episode 6, I will guide you throughout what fundamental analysis is all about, and everything you need to know about the fundamental analysis. Are you getting my point right now? So let's continue. In the world of trading, understanding the underlying forces that move the market is just as important as reading price charts. Are you getting my point right now? This is where fundamental analysis comes in. Unlike technical analysis, which focuses on price pattern and indicators, fundamental analysis looks at economic, financial, and political factors to determine the true value of an asset. In this our section, we will explore what fundamental analysis is, why it matters, key tools and strategies for traders and investors. I get my point right now. So let's continue from where we stop. What is fundamental analysis? Fundamental analysis is the study of factors that affect the intrinsic value of a financial asset. Traders and investors use it to predict whether an asset is undervalued, overvalued, or fairly priced. So what does it mean? It is the study of factors that affect the intrinsic value of a financial asset, whether it is a stock, crypto, or indices, no matter what. And traders and investors use it to predict whether an asset is undervalued, or whether an asset is overvalued, or whether an asset is fairly priced. So it applies in various markets, including the forex market, which have these things we call economic indicators, interest rates, and central bank policies. So in the forex market, fundamental analysis applies the forex market in the economic indicators, in the interest rates, and in the central bank policies. Then in the stock market, which is stocks, what affects it is the earning report, the PE ratio, and the revenue growth. Then in commodities, what affects it is the supply or demand dynamics and geopolitical events. Are you getting my point right now? So let's continue. The goal is to make informed decisions based on real world factors rather than relying solely on price movement. Are you getting my point right now? Let's continue. Then you ask yourself why fundamental analysis matters. Fundamental analysis helps traders and investors: 1. Understand market drivers. Know why prices move and not just how. Number 2. Identify long-term trend. Spot potential uptrend or downtrend before the market reacts. Number 3. Manage risk effectively. Anticipate events that may impact your positions. Number 4, enhance trading strategies. Combine with technical analysis for higher accuracy. In Forex, for example, a central bank interest rate hike can strengthen a currency, while poor economic data can weaken it. Are you getting my point right now? So let's continue. You'll be asking yourself, what are the key components of fundamental analysis? So in this video and in this section, you will know what are the key components of fundamental analysis. Number 1, the economic indicators. Economic indicators reflect the health of a country's economy and directly influences currency, values, stock price, and commodities. And common indicators include gross domestic product, which is the GDP, which measures the total economic output. Then we have inflation rates such as CPI and PPI, which indicates the rising or falling price. Then we have unemployment rate, which reflects labor strength. Then we have retail sales, which shows consumer spending patterns. Then we have trade balance, which shows export versus import affect currency strength. Are you getting my point right now? So let's continue. Then we have trading tips. High impact economic reports can cause significant market volatility. So always monitor the economic calendar. Are you getting my point right now? So whenever you want to trade, make sure you check out your economic calendar before trading, because high impact economic reports can affect market volatility very, very well, especially if you are trading the NFP, which is the non-farm payroll that always happen on the first Friday of every month that comes from the United States. Are you getting my point right now? So you need to be very, very careful. So you need to check out this website where you can check out the fundamental news. For example, forexfactory.com. These are one of the economic websites or economic report websites that you can check out for yourself if you want to trade the fundamental analysis, or before trading any currency pair at all. You need to first of all check out the news to avoid hurting your trading account. Are you getting my point right now? So let's continue from where we stop. Number 2, interest rates and central bank policies. Central banks control monetary policies and influences market liquidity. The key factors include interest rate decision, which are higher rates strengthen currency or low rates weakens it. Meaning that when the central bank increase the interest rate, then it strengthens the currency. But when they lowers the interest rate, it weakens the currency. Then we have quantitative easing. So quantitative easing means expand money supply, potentially weakening the currency. Then we have forward guidance, which signals future policy influencing market expectation. Example is when the Federal Reserve raises interest rate, then the US dollar often strengthens against other currencies. Are you getting my point right now? So let's continue from where we stop, which is number 3, political and geopolitical events. Political stability or uncertainty affects market sentiment. Election and government policies, which is number 1. We have trade agreement or dispute. We have war or conflict, or also we have regulatory changes. Markets often react to news before the fundamentals fully materialize, creating trading opportunities. Number 4, we have corporate and industrial analysis, which is stocks. For stock traders, fundamental analysis involves examining in a country's 1, financial statements, which are balance sheet, economic statement, or cash flow. Then we have earning reports and forecasts. Also, we have profit margins and debt level. And also, we have industry trend and competition. So these metrics help determine a stock's fair value and growth potential. Then number 5, you have market sentiment. Market sentiment reflects the overall attitude of traders and investors. It can be bullish, optimistic, which is optimistic, or bearish, which is pessimistic, and often interact with fundamental factors, which are the following: survey of investors' confidence. 2, positioning data. example futures or futures commitment. Then number 3, we have volatility indices, which we call VIX. Then let's continue. How to use fundamental analysis in trading. So let's continue. Number 1, identify the asset. Choose a currency, stock, or commodity to analyze. Number 2, analyze economic data. Check relevant economic indicators, interest rates, and industry reports. Number 3, assess market impact. Determine how the data may influence the asset price, which is positive news, potential upward move, or negative news, which is potential downward move. Number 4, combine with technical analysis. Use fundamental analysis for direction and timing. Then use technical analysis for entries, exits, and risk management. Number 5, monitor news and events. Stay updated with reliable financial news sources and economic calendars. Then let's go to the strengths of fundamental analysis. 1, provide insight into long-term trend. This strength of fundamental analysis is more of advantages of fundamental analysis. Number 2, explains why the market moves, not just how. Number 3, applicable across all markets, forex, stocks, or commodities. Number 4, helps avoid emotional trading decisions. Number 5, can be combined with technical analysis for a comprehensive strategy. Then we have limitations of fundamental analysis. Number 1, markets may react unpredictably to news. Yes, of course. Markets may react unpredictably to news, which is very important. Number 2, time consuming to gather and analyze data. Number 3, short-term traders may find signal too slow. Number 4, requires understanding of economics, finance, and geopolitics. Then let's continue. Tips for successful fundamental trading. Number 1, use an economic calendar, which means track key events and announcements. Number 2, focus on high impact news, which is talking about not all data affect market equally. For example, how the CPI reacts is not as the same how the non-farm payroll reacts. Are you getting my point right now? So they have different reaction in the market. Let's continue. Number 3, combine with technical indicators, which means that you need to make use of technical indicators to help you in your entry and exit precision, which helps in improving it. Number 4, stay disciplined. Avoid trading based on rumors or emotions. Number 5, keep a trading journal. Track trades and outcomes to refine strategies. Then in conclusion of this very section, fundamental analysis is the backbone of smart trading and investing. By understanding economic indicators, interest rates, corporate performance, and political events, traders can make informed decisions and anticipate market movement. While it may not provide the exact timing of trades when combined with technical analysis, fundamental analysis allows traders to see the bigger picture, identify opportunities, and manage risks effectively. Mastering fundamental analysis is the key to step towards becoming a confident and successful trader. Are you getting my point right now? Let's continue from where we stop, which is news trading and how to profit from market moving news. So in this very section, I'm going to be talking about news trading and how to profit from the market news. It is also under fundamental analysis. In financial markets, news can move prices faster than any technical indicators. From economic reports to geopolitical events, traders who understand news trading can capitalize on short-term volatility and make a high probability trades. So in this section, we will explain what news trading is, why it works, key strategies, and how to manage risk effectively. What is news trading? News trading is a trading strategy that focuses on taking position in the market based on economic, political, or corporate news. Unlike traditional technical analysis or unlike traditional technical trading, which relies on price charts and indicators, news trading leverages market reaction to real-world events. This makes it ideal for short-term traders and scalpers who want to exploit volatility spikes. Why news trading matters? So you need to know why and how news trading matters. Number one, news trading is very important because one, market often reacts quickly to new information. That is number one. Number two, react or create high volatility opportunity for profit. Number three, complement technical or fundamental strategies. Yes, news trading complement technical or fundamental strategies. Number four, news trading helps traders anticipate sudden price movement. So news trading helps traders anticipate sudden price movement. So in Forex, for example, an interest rate announcement from the Federal Reserve can move the US dollar against other currencies within seconds. In stocks, any report or M&A news can cause massive price swings. What are the key types of news that move markets? So in this section, you need to know the key types of news that move the forex market, which I'm going to be listing in this section. Number one is the economic data. Economic reports are critical in forex and equity trading. Examples include interest rates or central bank announcements. Number two, GDP growth figures. Number three, inflation data, which are the CPI and PPI. Then we have the number four, which is the employment report, which is the non-farm payroll or unemployment rate. Then number five, we have retail sales and consumer confidence. Then number two, corporate news. For stock traders, company-specific news can drive price action. Number one, quarterly earning reports. Number two, mergers and acquisitions. Number three, dividend and announcements. Number four, product launches and regulatory approval. Number three, geopolitical events. Political or geopolitical development often impact multiple markets, which are the election and government changes. Two, trade agreement or tariff. Three, war or conflict. Then four, natural disaster. So these are the things that affect the market in geopolitical events. Then number four, market sentiment and unexpected events, which are the market rumors or leaks, sudden policy changes, which is number two, and number three, unexpected central bank decision. Let's continue. How news trading works. So you need to know how news trading works. Number one, identify high impact news. So use an economic calendar or reliable news source to track events. Focus on high impact news release, which is typically cause the largest market movement. So we have high impact news release, for example, the CPI and the NFP, non-farm payroll, that drops every first Friday of every month. And you can check out this kind of news on forextrade.com and also investing.com and other news, economic, financial market websites. Then let's continue from where we stop. Number two, understand market expectation. Market often price in expectation before news release. Compare. So we have what we call forecasted data, which the analyst predicted. Then we have the actual data, which means the actual data that was released on that very day. So market reaction are strongest when the actual result differs significantly from the expectation. So market reacts very well when the actual result is different from what is being expected. Are you getting me? So when the forecasted data is less than more of the actual released data, market reacts very well. So let's continue. Number three, trade based on market reaction. So there are two main types. There are two main approaches. Before the news, position in anticipation of a move is high risk. Then requires strong understanding of market sentiment. Then number two, after the news, wait for confirmation of market direction. Enter trade once initial volatility settles, and lower risk with higher precision. Number three, let's continue, which is popular news trading strategy. Right now, in this section, I'm gonna be telling you the popular news trading strategy. So there are many news trading strategy. For those of you who don't know that we have news trading strategy, the type of strategy that can be applied during news trading. Number one, straddle strategy. By straddle strategy, how does it work? Place a buy and sell stop orders above and below the current price before the major news release. Then one order triggers capture the breakout. One order triggers capturing the breakout. Then what you need to do is to cancel the opposite order to manage risk. Number two, fade the news, which is another strategy. How does it work? Trade against the initial reaction if the move is overextended. Then the number two is look for a reversal candlestick pattern or support or resistance level. Then number three strategy is momentum trading. Ride the trend created by strong news, which is number one. Use price action or trend flowing to like moving average for confirmation. Then place stop loss at the recent swing points. Are you getting my point? So let's continue. This section will be talking about risk management in news trading, because there are risk management in news trading. Because as a trader, you need to always apply risk management whenever you are in trading. Are you getting my point right now? So this one is the risk management in news trading. Number one, or before I say this, news trading involve high volatility, which I've always been saying, which increases both profit potential and risk. So here are the key tips you need to know. You need to apply risk management in this news trading. Number one, use tight stop loss, which means protect your capital during rapid price swing. Number two, trade small position sizes, which means reduce exposure to sudden spike. Number three, overtrading, which means focus on high probability events. Number four, shake spread and liquidity, which means some brokers widen spread during news releases. Then number five, have a clear exit plan, which means identify profit target and stop loss level in advance. Then let's continue. What are advantages of news trading? So what are the advantages of news trading? Here are the advantages of news trading. Number one, exploit high volatility for potential fast profit. Number two, allow trading across multiple markets. Then number three, can be combined with technical analysis and fundamental analysis. And also news trading, high impact news can move markets significantly, providing quick opportunities. Then what are the disadvantages of news trading? Because like I have always tell you, anything that have an advantage also have disadvantage. Are you getting my point? So what are the disadvantages of news trading? Number one, extremely high risk. Price can spike unpredictably. Number two, slippage and widening spread may reduce profitability. Number three, requires constant monitoring of news and economic calendars. Then number four, emotional discipline is critical. Rapid movements can trigger impulsive trades. Let's continue. What are the tips for successful news trading? So I'm gonna be telling you five tips. I'm gonna be explaining to you 5 tips for successful news trading. Number one, focus on major news events. For example, if you are trading forex, focus on non-farm payroll, CPI, central bank rate. Then if you are trading stocks, focus on earnings and M&A news. Number two, prepare in advance. Know the support or resistance level before the news hits. Number 3, stay calm during volatility. Avoid panic trade during the initial spike. Number 4, combine with technical analysis. Use sharp pattern and trend line for confirmation. Number 5, demo trade first, meaning practice reacting to news in a risk-free environment on your demo account. So practice how to react to news activities on your demo account before applying it on your real money. Then, in conclusion of this section, news trading is a high risk and high reward strategy that allows traders to capitalize on market moving events. By understanding economic indicators, corporate announcements, geopolitical developments, and market sentiment, traders can make informed decisions and exploit short-term volatility. While it requires preparation, discipline, and risk management, news trading can be a powerful addition to any trader's toolkit, especially when combined with technical and fundamental analysis. I get my point right now. So let's talk about microeconomic indicators, which is a complete guide for traders. Understanding microeconomic indicators is essential for traders and investors. So as a trader, you need to understand microeconomic indicators. These indicators reflect the overall health of an economy and can have a profound impact on financial markets, including forex, stock, commodities, and bonds. This guide will explain the most important macroeconomic indicators, how they affect markets, and how traders can use them to make informed decisions. What are microeconomic indicators, if I may ask? Macroeconomic indicators are statistical data that measures the performance of an economy. They help traders, investors, and policymakers understand economic trends, growth prospects, and market risk. Indicators can be leading, meaning predict future economic trend, lagging, which means confirm trend, and also confident, which means reflect the current state of the economy. Then, what are the key macroeconomic indicators? The key macroeconomic indicators: number 1, the interest rate. Interest rate. What are the interest rates, if you may ask? Interest rates are one of the most important drivers of financial markets. So the definition is this: the cost of borrowing money set by central bank like the Federal Reserve, the European Central Bank, or Bank of England impact the market. Are you getting my point? Number 1, higher rate. Stronger currency, lower stock price means higher borrowing cost. Then lower rate, weak currency, high stock price, cheaper borrowing. Why it matters? Traders watch central bank decision for potential market moving opportunities. That is number 1. Number 2, inflation, the CPI or the PPI. Inflation measures how quickly prices for goods and services are rising. Inflation measures how quickly the goods and services of particular currencies are being consumed. So under inflation, we have the consumer price index, which is the CPI, which measures the retail price changes, shows cost of living trend. Then PPI, which means producer price index, which measures the prices at the wholesale or producer level, indicates upstream inflation. So here are the market impact. 1, high inflation. Central bank may raise interest rates for stronger currency or weaker stock market. Low inflation. Central bank may cut rates for weaker currency and for stronger market and for stronger stock market. Trading tips. Inflation data often causes sudden spike in forex pair and equity indices. Then number 3, GDP growth. Gross domestic product (GDP) measures the total amount of goods and services produced in an economy. Then the market impact. 1, strong GDP growth. So what are the strong GDP growth? Strong GDP growth are the positive economic output which helps in the bullish for currency and equity. Are you getting my point right now? Then we have weak GDP growth. Weak GDP growth is the economic slowdown which is bearish for currencies and equities. Then what are the trading tips? Trading tips on trading the GDP is growth. GDP growth announcement often trigger strong market reaction in forex and global stock market. Number 4, employment data, which is the NFP or unemployment rate. Employment figures provide insight into labor market strength. For example, we have non-farm payroll, which is the NFP, which measures job creation in the US, excluding farm workers which is being released every month. We have 2, unemployment rate, which measures the percentage of unemployed workers actively seeking employment. So what are the market impacts of this employment data? Number 1, strong employment, which means higher consumer spending, which is the bullish for currency. Then we have weak employment, which means slower economic growth, which means bearish for currency. Then I want to share the trading tips. NFP is one of the most volatile economic reports, often moving forex pair like the USD and the euro or euro dramatically. Are you getting my point? Also, it also moves gold. I forgot to add it. Then we have number 5, trade balance. What are trade balance? Trade balance measures the difference between a country's exports and imports. So we have positive balance, which is surplus. Exports is less than imports. Then what is happening is the currency strength increases. Then negative balance is which is deficit, when the import is more than the export, then the currency weakens. Are you getting my point? So the market impact, 1, it affects how does it impact the market? The trade balance affect the currency demand, inflation, and overall economic growth. Are you getting my point? So let's continue. We have number 6, retail sales and consumer confidence. This indicator reflects consumer spending, which drives a large portion of economic growth. Number 1, retail sales, which measures total sales at retail stores, indicates consumer demand. Then we have consumer confidence index CCI, which measures how optimistic consumers are about the economy. What are the market impacts? Higher consumer confidence and retail sales, which equals to stronger currency, positive stock market sentiment. Lower consumer confidence, which is weak currency, potential market slowdown. And then what are the trading tips? The trading tips are retail sales and confidence reports often influence short-term market trend and can confirm broader economic trend. Let's continue. How traders use microeconomic indicators. Forex trading use interest rate, inflation, and GDP to anticipate currency movement. Then number 2, stock trading evaluate GDP growth, employment data, and consumer metrics to identify bullish or bearish market conditions. Number 3, risk management. Avoid trading during high impact news without a clear strategy. Number 4, combine with technical analysis. Use indicators to predict market direction and then technical tools to time entries and exit. Let's continue. What are the tips for trading around microeconomic data? So I'm going to be telling you the tips, and here are the tips. Number 1, always check the economic calendar for upcoming reports. Number 2, focus on high impact indicators like NFP, CPI, and GDP, and interest rate decision. Number 3, consider market expectation versus actual results for potential volatility. Then number 4, use tight stop losses during news events due to sudden spikes or price spikes. Then the last one, which is number 5, combine fundamental indicators with trend line, support or resistance, and candlestick pattern for better accuracy. Then in this conclusion, microeconomic indicators are crucial tools for traders and investors. By understanding interest rates, inflation, GDP growth and employment data, trade balances and consumer metrics, traders can anticipate market movement and make informed decisions. When combined with technical analysis, these indicators provide a comprehensive view of market trend, allowing traders to identify opportunities, manage risk, and improve profitability in forex, stocks, and other financial markets. Mastering economic indicators is the key to becoming a confident, well-informed trader who can navigate both short-term volatility and long-term market trend. So let's continue. What are the key market drivers? So in this section, I'm going to be telling you the key market drivers, which are the central banks, geopolitics, and correlated markets. In the financial market, price movements are influenced by more than just supply and demand. If you don't know, price movement in the forex market are influenced by more than just supply and demand. Central bank policies, geopolitical events, and correlated markets play a crucial role in shaping market trends. Understanding these factors allow traders and investors to make informed decisions, anticipate market moves, and manage risk effectively. In this section, we will explore the essential market drivers and their impact on forex, stocks, commodities, and cryptocurrencies. Number 1. The central bank and monetary policies. Central banks are the backbone of any economy, controlling monetary policy to maintain price stability and stimulate growth. So the key central banks include Federal Reserve, Fed, which is in the United States of America. Then we have European Central Bank, which is the ECB, the Eurozone. We have Bank of England, which is in the UK, BOE. Then we have Bank of Japan, which is a BOG, which is in Japan. And we have others like Reserve Bank of Australia, which is in Australia, and also we have Bank of Canada, which is the BOC, etc. So what are the key monetary policies tools that affect the currency of these countries? Number 1, interest rate. So interest rate, the primary tool influencing borrowing costs and currency strength. Then we have rate hikes, stronger currency with lower stock price. Then we have rate cuts, which means weaker currency and high stock price. Then we have quantitative easing, which is being abbreviated in QE, meaning buying financial assets to inject liquidity in the market. Then we had forward guidance, which means statements about future policy to guide market expectation. Then we have reserve requirement, which is the minimum fund banks must hold, and so that it will impact the imparting lending capacity. Then what are the market impacts? Central bank decision can cause massive volatility in the forex, equities, and bond markets. Traders often monitor interest rate announcements and policy statements to anticipate currency strength, bond yield, and stock performance. Example, a Fed rate hike often strengthens the US dollar against other currencies, while the quantitative easing, which is the QE program, can weaken it. Number 2, geopolitical events. Geopolitical events can cause sudden dramatic market movement. Events like war, elections, sanctions, and trade disputes often impact investor sentiment and capital flows. So the key geopolitical drivers are war and conflict. So war and conflict increase demand for safe haven assets like the gold, the US Treasury, and the USD. Election change market expectation depending on policies of the incoming government. Number 3, sanction and trade wars. This disrupt supply chain affecting commodities, currencies, and stocks. Then we have global crisis, which means pandemics, natural disaster, or political instability influences risk sentiment. Are you getting my point? So what are the market impacts? Number 1, safe haven assets like gold, yen, and Swiss francs typically rises during uncertainty. Risk on assets like stocks and high-yield currencies may drop. Then commodities like oil can spike due to supply disruption. But in all this, traders must stay updated to global news and anticipate potential market reactions. Then number 3, correlated markets. Many financial markets are interconnected, meaning movement in one market can influence others. So understanding this correlation helps traders manage risk and identify market opportunities. Number 1, we have the key correlated market, which is number 1, you have the gold, which is the XAU-USD. So it's often inversely correlated with the US dollar. So the gold is inversely correlated with the US dollar if you don't know. And also rises during geopolitical tension or inflation fears. Number 2, we have oil, WTI or Brent, which affects currency of oil exporting countries like Canada and Norway. Also which affects price spikes and influence inflation expectation. Then 3, we have bonds, which are the treasuries, gilts and JGBs, which the central bank policy impacts yields and bond prices. Then higher yields attract investment in bonds, strengthening the currency. Then number 4, we have stocks or equities, which have the risk on sentiment increases, which increases the stock price, and also risk of sentiment shifts capital to safe haven assets. Then number 5, we have cryptocurrency like BTC, ETH, and etc., which increasingly influenced by macroeconomic trend and risk appetite, and also often shows correlation with tech stock or speculative markets. Then you need to ask yourself, why does correlation matters? Yes, of course, correlation matters and it helps you one in hedging. Traders can reduce risk by understanding market relationships. Number 2, opportunity and identification. Price movement in one market can hint a potential trade in another. Number 3, risk management. Avoid exposure to conflicting positions across correlated assets. Example, rising oil price may boost the Canadian dollar, CAD, while geopolitical instability may drive investors to gold and US treasuries. Let's continue. How to use these market drivers. So how to make use of these market drivers? Number 1, monitor central bank announcements. Trade currency pairs, bonds or indices based on interest rate changes or QE programs. Number 2, stay informed on geopolitics. Avoid unexpected losses by adjusting position before election, sanction on politics or conflict. Number 3, analyze correlated markets, meaning use gold, oil and bond to confirm trend in forex or equity markets. Number 4, combine with technical analysis. Identify support or resistance, trend and entry point for better risk to reward. Number 5, manage risk carefully. Sudden news events can cause rapid price swing. Always use stop losses and position sizing. What are tips for successful trading around these drivers? Number 1, follow economic calendars and central bank meeting schedules. So number 1, you need to follow economic calendars and central bank meeting schedules, which is very, very important. Number 2, you need to track global news resources for geopolitical development. It's very, very important. Number 3, study historical correlation between assets to participate market reaction. Number 4, avoid overexposure to highly correlated markets during volatile periods. Number 5, combine fundamental knowledge with price action or indicator for precision entries. I get my point. So, in my final conclusion, in this very chapter, you need to know this. Central banks, geopolitical events, and correlated markets are key forces that shapes financial markets. Central banks influence currencies, stocks, and bonds through interest rates and monetary policies. Geopolitical events triggers risk on and risk off sentiment affecting multiple markets, and correlated markets provide high insight in price movement and help manage risk. So traders who understand these market drivers can anticipate trend, identify opportunities, and protect their investment. Combining this knowledge with technical analysis and proper risk management creates a powerful trading strategy for forex, stock, commodities, and cryptocurrencies. So in all these things, as a trader, you need to focus not just on fundamental analysis, but also as you're focusing on fundamental analysis, you need to focusing on also technical analysis, because these three analysis, technical analysis, fundamental analysis, and sentimental analysis, all of them joined together helps in shaping the market behavior. Because when there are market news, the market moves, and it also moves in the direction of the news. So you need to apply technical analysis and also fundamental analysis in your trading career, so that it will help you to understand how the market works and what drives the market. So fundamental analysis is very, very important. So that is why I take my time to break everything down for you, for what drives the fundamental analysis and who are the economic drivers of fundamental analysis. So much many things, from beginning from the central banks who influences the the currencies through stocks, bond, and interest rate and monetary policies, through geopolitical events which triggers risk on and risk off based on sentiment and multiple markets affecting it, to also correlated markets which provide insights to price movement and also helps in managing risk. So it is very, very important for you to know and understand why fundamental analysis is a key core to your trading career once you are interested and want to trade the financial market, because fundamental analysis goes all across all markets. It goes across the forex market, it goes across the stock market, and also it goes across the crypto market, even the commodities market. So you can't do without the fundamental analysis once you are trading the financial market. I get my point. So if you have watched this video up to this moment, let's head over to the next episode, which is the episode 7. So let's head over to episode 7 right now. I will see you on episode 7. Thank you. So hello guys, welcome back to episode 7. So let's continue from where we stop, which is the continuation from our episode 7. So in this episode 7, I'm gonna be teaching you about trading strategies, which is a complete guide for smart traders. So as a trader, you need to understand trading strategies. So and this episode 7 will break down everything for you on what you need to know about trading strategies. Are you getting my point? So everything concerning the trading strategy in the forex market or in the financial market, this episode 7 is at the best to give you everything and anything you want. So let's continue. Successful trading is not luck, no. It is about having a proven strategy. A trading strategy provides a systematic approach to analyzing markets, identifying opportunities, and managing risk. Whether you are a beginner or an experienced trader, understanding different trading strategies can dramatically improve your results. In this guide, we will uncover the popular trading strategy, how they work, and tips to maximize results. Let's continue. What is a trading strategy? A trading strategy is a set of rules and techniques that a trader follows to make buy and sell decisions. So in the financial market, it is often combined with number 1, market analysis. So which helps, what are these market analysis? The market analysis include the technical, fundamental, or both. These are the market analysis. The next one is entry and exit rules, when to buy and when to sell. Then the next one is risk management, which is your stop loss, position sizing, and take profit target. So having a strategy removes emotion from trading and helps you maintain consistency. I get my point right now. You'll be asking yourself, what are types of trading strategies? So we have so many types of trading strategy, and I will be breaking it down for you one after the other. Number one, trading strategies can be categorized into several types based on time frame, analysis method, and risk tolerance. Number one, we have trend following strategy. Trend following strategy, which involves trading in the direction of the market trend. How does trend trading strategy works? One, identifying an uptrend, higher high and higher low, or downtrend, which is lower high and lower low. Enter trades in the direction of the trend. And what are the tools? The tools you'll be using are the moving averages, trend line, ADX, and the price action. What are the pros of trend line following strategy? It works well in a strong trending market. What are the cons of trading trend following strategy? They are less effective in sideways markets. What are the examples? Let me give you an example. Buying a currency pair when the 50 exponential moving average crosses above the 200 moving average, which is normally called the golden cross. Then we have number two. We have range trading strategy. What are range trading strategy? Range trading is based on the idea that market moves between support and resistance level. How it works? You buy near support and sell near resistance. Then what are the tools? The tools we'll be using as support and resistance level. The RSI, which determines the overbought and the oversold condition, and the stochastic oscillator. What are the pros of range trading strategies? Number one, and only that it works well in sideways or consolidating market. And what are the cons? The cons is that it fails during trending market. And the example of this is selling a stocks on an asset when it approaches resistance after repeated bounce. Then let's go ahead to the next trading strategy, which is breakout strategy, which is number 3. Breakout trading focuses on capitalizing on price movement beyond key levels. So how does it work? 1. Enter a trade when a price breaks a significant support, resistance, or chart pattern. What are the tools? Tools are the Bollinger Bands, trend line, or moving averages. What are the pros? It captures large move easily. And what are the cons? Moves for false breakouts can lead to losses. Then the examples are buying a currency pair when it breaks above a long-term resistance level. Then what is the momentum strategies? So which is number 4. Momentum trading relies on the idea that strong price movement will continue in the same direction. How does it work? It identifies assets with strong upward or downward momentum and enter trade in the same direction. So what are the tools? The tools are the RSI, the MACD, and the volume indicators. And what are the pros? The pros are it is profitable in fast moving market, and the cons are it requires careful risk management as momentum can reverse quickly. Example, when buying a stock after a major earning beats that beats that pushes it sharply high. So we have number 5, scalping strategies. So what are scalping strategies? Scalping strategies involve making quick and small trades to capture minor price movement. And what are the time frame? The time frame ranges from seconds to minutes. And what are the tools? The tools are level 2 data, 1 minute chart, and the moving average. What are the pros of scalping strategy? You can generate frequent profit consistently. And also the cons of these things are it requires a high concentration low transaction cost, and fast execution. Examples: buying and selling a currency pair within minutes to profit from tiny price fluctuation. Number 6, news trading strategy. What are news trading strategy? News trading is based on market reaction to economic reports or major economic announcements. So how does the news trading strategy works? Number 1 is that enter trade before or after high impact news events such as the interest rate decision, the NFP report, which is the non-farm payroll, or any announcement. Number 2, which are the tools? The economic calendars or real-time news feed. Then what are the pros of news trading strategy? Which are the high volatility, which provides high volatility in profit opportunities, and the cons are high risk due to sudden spikes and slippages. So what are the examples? Examples is this: trading the US dollar or the euro based on an unexpected CPI data release. Then number 7 is swing trading strategies. Yes, of course, swing trading strategy. Swing trading targets medium-term price movement. So what are the time frame for this swing trading? Time frame are the hours to days or weeks, as the case may be. So how does this swing trading strategy works? It works based on capture market swings within a trend or range. What are the tools for this swing trading strategy? The tools are trend line, support or resistance, moving average, or candlestick patterns. So what are the pros of the swing trading strategy? The pros are less time intensive than the trading. The cons are exposed to overnight risk. So the swing trading strategy are exposed to overnight risk. That is the disadvantage in swing trading strategy. And also the advantage is that they have less time intensive than day traders. Then I will give you an example. Buying a stock or buying a currency asset after a pullback within an overall uptrend and holding it for a few days. Are you getting my point? So let's continue. What are the essential elements of a successful trading strategy? So the essential elements of a successful trading strategy. Number 1, clear rules. Define exact entry, rules, exits, and risk management rule. So the first thing you need to do in order to have a successful trading strategy is to define your exact entry, define your exact exit, and also define your exact risk management rule. It will help you a very lot. Are you getting my point? Then number 2 is risk management. So you need to never risk more than 1 or 2% of your accounts per trade. You need to be very, very, very careful when trading. Make sure you always apply a proper risk management. Never and don't risk more than 1 or 2% of your accounts per trade. Number 3 is backtesting. Backtesting, by this I mean test your strategy on historical data before trading live. So you need to test your strategy on a demo account or on a historical data before trading live. Number 4, discipline. Follow strategy strictly without emotion interference. So you need to be disciplined when following your strategy. Are you getting my point? You need to be disciplined when following your strategy. Don't attach your emotion. Don't attach emotions when trading. That is when you need to be disciplined. Then number 5, adaptability, meaning adjust strategy according to market condition, whether it is trending, ranging, or volatile. So you need to adjust according to your market condition. Are you getting me? So you need to adjust your trading strategy according to market condition, whether it is a trending, whether it is ranging, or whether it is volatile. You need to adjust your trading strategy so that it will fit in the market condition. So are you getting my point right now? Don't just trade blindly. Always adjust your trading strategy whenever you see the market condition changes. That is the simple and short of it. Then let's head over to the tips for traders. What are the tips for traders? Combine technical and fundamental analysis for higher accuracy. So whenever you are trading, you need to combine technical analysis and also fundamental analysis for higher accuracy whenever you are in trading. It is very, very important. Number 2, focus on one or two strategies instead of overcomplicating your trading plan. So instead of you overcomplicating your trading plan, just focus on one or two trading strategy. I get my point. Then number 3, keep a trading journal to track performance and refine your strategy. Number 3 is that keep a trading journal to track performance and refine your strategy. Number 4, stay updated on market news and economic events that can affect your trade. So you need to stay updated on market and economic events that can affect your trade when trading. Then number 5, always use stop loss and take profit level to protect your capital. So always make use of your stop loss and take profit level to protect your capital. It is very, very important. Always set your stop loss and at the same time set your take profit whenever you are in any trade. Are you getting my point? So that you don't blow your trading account. It is very, very important. Then, in conclusion of this section, trading strategies are essential for consistent success in the financial market. Whether you prefer trend following, breakout trading, scalping, swing trading, or news trading, the key is to follow a structured plan with proper risk management. By mastering trading strategies and combining them with technical and fundamental analysis, traders can maximize profits, reduce losses, and approach the market with confidence. Now, let's talk about trading style. Yes, I'm going to be explaining in this section trading style explained, scalping, day trading, swing trading, and position trading. So, when it comes to trading, choosing the right style is crucial for success. Are you getting my point? Every trader has a unique personality, risk tolerance, and time availability, and your trading style should match these factors. The four most common trading styles are scalping, day trading, swing trading, and position trading. So in this section, we will explain each style, their pros and cons, and tips for maximizing profitability. Are you getting my point? So let's continue. Number 1, scalping. What is scalping? Scalping is the fastest trading style that is focused on taking advantage of a tiny price movement. So a scalper is someone who have a fast trading style, and that person is focused on taking advantage of a small or tiny price movement in the market. So what are the time frame of a scalper? Their time frame ranges from seconds to minutes. And what are the goals of a scalper? Their goal is to capture small profits frequently throughout the whole day. Then, what are the tools of a scalper? Their tools are 1 minute to 5 minute charts, level 2 data, moving average, and the Bollinger Band. Then, what are the market of scalpers? What type of market do they exist? Scalpers can trade the forex market, they can trade the stock market, they can trade the crypto market, and also they can trade the futures market, whichever market they want and the one they like. Then what are the pros of scalping, or what are the pros of scalpers, which means the advantage of being a scalper? Number 1, can generate multiple small profits daily. Scalpers can generate multiple small profits daily based on a small market movement and volatility. Number 2, requires minimal market forecasting. So scalping requires minimal market forecasting. Understand? Yes, it requires minimal market forecasting. Number 3, scalpers take advantage of volatility. Yes, scalpers take advantages of volatility in the market. Then what are the cons or disadvantages of scalping? Number 1, it requires high concentration and discipline. So scalping requires high concentration and discipline. Also, scalping requires high transaction cost, which can reduce profit. So, scalping requires high transaction cost, which can reduce profit. And also, scalping requires emotionally demanding. Yes, scalping is emotionally demanding because you are trading here and there because of the small price movement in the market. So you need to capture the price movement for you to make money. Then what are the best practices for scalping? So the best practices for scalping is trade liquid market with tight spread. Yes, of course. As a scalper, you need to trade liquid market with tight spread. Number two is use strict stop loss and position sizing. As a scalper, you need to use and follow a strict stop loss and position sizing. And also, as a scalper, you need to avoid trading during low volume period. Yes, as a scalper, you need to avoid trading during low volume period. Number two, day trading. Day trading. Day trading involves opening and closing trades within the same day, overnight. Sorry, within the same day and avoiding overnight risk. Yes, of course. Day trading involves trading and opening of trading and closing of trade, but it will be on the same day. I get my point. So what are the time frame of the traders? The time frame for the trader ranging from 1 minute to hours. And what are the goals of day traders? The goal of a day trader is to capture intraday price movement. Yes, that is the goal of a day trader, to capture the intraday price movement. And what are tools for day traders? There are tools ranging from 5 minutes to 1 hour chart. Yes, of course. There are tools ranging from 5 minutes to 1 hour chart, moving averages, RSI, MACD, support or resistance. Yes. What are the markets for day traders? Their markets include the forex market, the stock market, the indices, and the commodities market. So what are the advantages of being a day trader? Number one, no overnight risk from news event. Yes, as a day trader, there is no overnight risk from news event. Then number two, many trading opportunities daily. So there are many trading opportunities during the day as a day trader. And also number three, can adapt to market condition quickly. You can adapt to market condition very quickly. Then what are the disadvantages of being a day trader? Because anything that has advantages also has disadvantages. Are you getting my point right now? So the disadvantages is time intensive and requires focus. Yes, the trading is time intensive and it requires focus. Number two, can lead to overtrading. The trading sometimes can lead to overtrading if you're not very careful about that. Then number three, requires a reliable platform and low spread. So the trading requires a reliable platform and low spread. So what are the best practices for day traders? Number one, plan trade in advance using technical analysis. So you need to plan trades in advance using technical analysis. Number two, track economic news for potential volatility. Yes, you need to track economic news for potential volatility. Number three, keep a daily trading journal. Yes, you need to keep a daily trading journal. Then let's continue. Number three, what swing trading who are swing trading or who are swing traders? Swing trading or swing traders target short to medium term trends. Yes, they target short to medium term trend, holding trades for several days or weeks. Yes, so swing traders are people who target short to medium term trend and they are holding trades for several days or weeks. What is the goal of a swing trader? The goal of the goal of sorry, not the goal, the time frame of swing traders. The time frame of swing traders ranges from hours to weeks. Yes, the time frame of a swing trader ranges from 4 hours, daily time frame, weekly time frame, and even monthly time frame. What are the goal of swing traders? The goal of a swing trader is to capture swing within a trend. Yes, the goal of a swing trader is to capture swing within a trend. And what are the tools for swing traders? Their tools are the daily and the 4 hour chart, the candlestick pattern, trend line and support or resistance. And what are the markets for the swing traders? We have forex market, we have the stock market, we have the commodities and the ETFs. So what are the advantages or the pros of being a swing trader? Number one, being a swing trader is less stressful than day trading or scalping. Yes, of course. Being a swing trader is less stressful. Yes, it is less stressful than day trading or scalping. That is number one advantages. Number two, it requires less screen time. Yes, being a swing trader requires less screen time on the market. Then number three, being a swing trader can capture you can capture larger moves on intraday trading. Yes, being a swing trader, you can capture larger market moves than intraday traders. Yes, so as a swing trader, one of the advantages is that you can capture a larger move than a normal day trader or scalpers. Yes, but also anything that has advantage also comes with its disadvantage. What are the cons of being a swing trader? Number one is that you are exposed to overnight you are exposed to overnight and weekend risk. Yes, of course, you are being exposed to overnight and weekend risk. Number two, it requires patience to wait for setups. Yes, it requires patience for you to wait for setup to mature and form. Then number three, it requires understanding of market trends. So you need to understand market trend very, very well for you to be a profitable swing trader. Then what are the best practices for swing traders? The best practices for swing trader is number one, use technical and fundamental analysis to identify trends. Yes, you need to use technical and fundamental analysis to identify trends. Number two is that you need to place stop losses to protect against unexpected reversals. Yes, you need to place stop losses to protect against unexpected reversals. Then number three, you need to track macroeconomic news that may impact your trades. Yes, so you need to track the macroeconomic news that may impact your trade. For example, you can check it out on forexfactory.com, which is the new news website, or investing.com, which is also another forex news website. Then number four, which is the position trading. Yes, of course, because we have different types of trading. We have scalpers, day trading, swing trading, and which is the next one is position trading, which is the number four. So what are position trading? Position trading is a long-term trading style, holding position for weeks, months, or even years. So position traders are people who are trading based on a long term, and they are holding position for weeks, months, or even years. Are you getting my point right now? So these people are holding position of a particular of trade for as long as weeks, even months, some years, to capture the long-term trend or fundamental shift. Are you getting my point? So what are the time frame of position traders? The time frame of position traders are weeks to years, some months. Then what are the goal of position traders? Their goal is to capitalize on long-term trend or fundamental shifts. Then what are the tools of position traders? Their tools are weekly and monthly charts. Yes, their tools are weekly and monthly charts, moving averages, microeconomic analysis, and company fundamentals for those who are trading the stock market. Yes, company fundamentals are for those who are trading the stock market. That is why I included it. Then what are the markets of position traders? Their market includes the forex market, it includes the stock market, the commodities market, and the indices market. So what are the pros or advantages of being a position trader? Number one, less time intensive and less stressful. Yes, it is less time intensive and less stressful. Number two, focus on large position from long-term trend. Yes, it is focused on large position from long-term trend. Number three, there is lower transaction cost due to fewer trades. Yes, there are lower transaction costs due to fewer trades. Then what are the disadvantages of being a position trader? Number one, it requires patience and discipline. Yes, being a position trader requires patience and discipline. Number two, being a position trader, you are exposed to a large drawdown during market correction. Yes, if you don't know that, know it from this video. Being a position trader, you are exposed to large market drawdown during market correction, and also you are exposed to low feedback. Results take time to materialize. Yes, so there are slow feedback, and results take time to materialize in position trading. So right now, what is the best practices for position trader? So best trades on long term technical and fundamental analysis. So the best trade on long term technicals and fundamental analysis. So they are trading based on long term. Number two, they make use of proper risk management and position sizing. So use proper risk management and, and position sizing as a position trader, and also avoid emotional reaction to short-term volatility. So you need to avoid emotional reaction to short-term volatility. It is very, very important. You need to avoid emotional reaction to short-term volatility. Then let's continue. How to choose the right trading style. So in this section, I will be telling you how to choose the right trading style. Number one, assess your personality. Yes, assess your personality. Do you strive under pressure? So do you strive under pressure? Scalping is for you, or prefer patience? Position trading is for you. Then number two, consider your schedule. Day trading requires full attention, while swing or position trading is less time intensive. Number three, determine your risk tolerance. Scalping and day trading are high risk, high reward, whereas swing and position trading are moderate risk. Then number four, evaluate your capital. Some styles like day trading may require large capital for effective risk management. I get my point. Then number five, start small and test. Practice each style in a demo account to find what suits you best. So in conclusion of this trading style, you need to understand this, that each trading style, whether it is scalping, whether it is day trading, whether it is swing trading, or whether it is position trading, whichever one you want, has a unique advantage and at the same time challenges. So choosing the right style depends on your personality. It depends on your personality. It depends on your risk tolerance. It depends on your time availability, and also it also depends on your market knowledge. So by understanding the pros, understanding the cons, and also the best practices for each style of trading, traders can develop a consistent approach, manage risk effectively, and maximize their profit. But remember, there is no one size fits all. You understand? So something like, there is nothing like the best one that fits everything, or the style. No. Successful traders often combine elements of multiple trading style to suit different market conditions. Understand? So successful traders combine different trading style. Some people combine the scalping, the trading, and swing trading. Some traders trade all of them depending on the market condition. I getting my point right now. So let's continue from where we stop. Let's move ahead to the next subtitle, which is top forex and stock trading strategies. So let's continue. So this top forex and trading strategy, we'll be talking about trend following, range trading, and breakout trading. Are you getting my point? So let's continue. Successful trading requires strategies that matches market condition. Whether you are trading forex, stock, commodities, or cryptocurrencies, having a clear approach can help maximize profits and minimize losses. Among the popular strategies are trend following, range trading, and breakout trading. Let's continue. What is trend following strategies? Trend following is one of the most widely used trading strategies. The idea is simple. The trend is your friend. So what are the concepts? The concept is this: identify an uptrend or downtrend and then enter trade in the direction of the trend. What are the tools for this trend following strategies. Number one is moving average using the SMA or the exponential moving average. Then you have trend line, we have ADX, and we have price action. Then what are the time frame? We have the short term or intraday to long term, which is the weekly or monthly chart. How it works? How does it work? Buy when price are making higher high and higher low in an uptrend. Then sell when prices are making lower high and lower low in a downtrend. So what is the advantages of trend following strategy? Number one, it works well in trending market. Number two, it can capture significant price movement. And number three, it is easy to combine with risk management techniques. Then what are the cons or disadvantages of trend following strategy? Number one, poor performance in sideways markets. And number two, it may suffer small losses during trend reversal. So what are the tips for traders, for people who want to jump in the trend following strategies? Number one, use moving average crossover to confirm the trend. Number two, combine with support and resistance level for better entry points. And also use trailing stops to lock in profit as trend continues. Let's continue. The second one, which is the range trading strategy. What are the range trading strategy? Range trading is based on the idea that prices is often move between support and resistance level without trending. And what are the concepts? Buy near support and sell near resistance. What are the tools? The tools include the RSI, the stochastic oscillator, support and resistance level, Bollinger Bands. And then what are the time frame? The time frame ranges to intraday to swing trading. How does the range trading strategy works? Number one, identify a market that is moving sideways. Then number two, buy when the price touches support and shows sign of bouncing. Then number three, sell when the price reaches resistance. So what is the advantages or the pros of range trading strategy? Number one, works well in consolidating market. It works well in consolidating market. Number two, it offers multiple opportunity within a well-defined range. Number three, low risk setup can stop. Number three, low risk setup when stops are placed correctly. Then let's continue with the con or disadvantages of range trading strategy. It fails in trading market, and also false breakouts can trigger losses. Then what are tips for traders who are trading the range trading strategy? Number one, avoid trading near breakout zone unless you have a breakout plan. Number two, confirm trades with momentum indicators like RSI or stochastic. Number three, keep stop loss tight to minimize risk. Then let's talk about the third one, which is breakout strategies. What are breakout strategies? Breakout trading aims to capitalize on strong price movement beyond key levels. And what are the concepts of breakout trading strategies? Number one, enter trades when price breaks above resistance or below support. And what are the tools? The tools are trend line, Bollinger Bands, moving averages, volume indicators. I get my point. Then what are the time frame? The time frame are intradays or swing trading. And how does breakout strategies work? Number one is identify a consolidation zone or key support or resistance level. Number two is enter a trade when the prices break above or below that level. Number three is use volume confirmation to produce false breakouts. Then what are the advantages of breakout trading strategies? Number one, it captures large moves early. It is effective in volatile or trending markets. And number three, it can generate high risk to reward ratio. So what are the disadvantages of or the disadvantages of breakout trading strategies. Number one is false breakouts can lead to losses, and also it requires discipline and quick execution. What are the tips for traders? Number one, wait for confirmation of the breakout. Example, candlestick close above resistance. Number two, use stop losses just below breakout level to manage risk. And number three, consider trading the pullback after breakout for safer entries. Then, what are the combining strategies? So combining strategy is combining the trend following plus breakouts. Then enter the breakout in the direction of the main trend for higher probability trades. Then range trading plus indicator plus trend indicator. Avoid entering ranges when the strong trend signal appears. Then breakout confirmation. Use volume and momentum indicators to avoid false breakouts. So in conclusion of this very section, choosing the right strategy depends on market condition, trader's personality, and risk tolerance. So it all boils down to the market condition that you are in, and also it all boils down to your personality as a trader, and also your risk tolerance, the amount of money that you are willing to risk in the market. So trend following is the best in trading market. Range trading works in sideways market, and breakout trading captures sudden high momentum moves. So traders who understand when and how to use these strategies can improve their consistency, maximize profit, and minimize losses. Combining these strategies with technical indicators, proper risk management, and market analysis is the key to long-term trading success. Are you getting my point right now? So let's head over to the advanced trading strategies, which are the carry trades, arbitrage, and hedging. So in the world of trading, success comes from not just analyzing market, but also employing the right strategies. Beyond trend following or day trading, advanced strategies like carry trade, arbitrage, and hedging provide opportunities for profit and risk management. In this section, we will explain these strategies, how they work, their pros and cons, and tips for traders. Are you getting my point right now? So what are carry trades? Carry trades is a popular strategy in forex that involves borrowing a low interest rate currency and investing in a high interest rate currency. What are the concepts of carry trade? The concept is this: profits from the difference in the interest rates between two countries, which is the carry. Example is this: borrowing Japanese yen, which is the low interest, to buy Australian dollars, which is the high interest. Then the time frame for this is between medium to long term trades. So how does carry trade works? Number one is to identify a currency pair with a significant interest rate differences. Then number two is buy the high yielding currency and sell the low yielding currency. Then number three is earn interest differential as long as the position is held. Then what are the pros? The pros of carry trade is it generates steady returns from interest rate differences. It has potential for capital gain if the high yielding currency appreciates. But disadvantages of carry trade is it exposure to exchange rate risk, and also vulnerable during period of market volatility or risk aversion. So tips for traders who are trading carry trade strategies. Number one, monitor global interest rate trend and central bank announcements. Number two, make use of stop losses to protect against adverse currency movements. And also, it best works in stable market condition rather than high volatility market period. Then let's talk about arbitrage. What is arbitrage? You might be hearing of this thing. Arbitrage is the strategy that exploits price discrepancies for the same asset across different markets or instruments. And what are the concepts of this arbitrage? The concept is this: buy low in one market and sell high in another to lock in a risk-free profit. Example is currency arbitrage, stock index arbitrage, or cryptocurrency arbitrage. The time frame is the very short term, seconds to minutes. Types of arbitrage. We have different types of arbitrage. We have spectral arbitrage, which prices the difference between two exchanges or markets. We have triangular arbitrage, which exploit differences in trade currency exchange rates. Then we have statistical arbitrage, which uses quantitative model to identify price inefficiencies. Then what are the advantages or pros of arbitrage? Number one is it provides low risk profit opportunity. Number two is that it is effective in highly liquid markets with multiple exchanges. What are the disadvantages of arbitrage? Is one, it requires fast execution and sophisticated technology. Number two, the profit margin are usually very small. And number three, competition from algorithmic and high frequency traders. Then what are the tips for traders who are trading arbitrage? Number one, use automated trading system for speed and precision. Number two, focus on high liquidity market to minimize spillage. Number three, constantly monitor market spread for opportunities. Number three, hedging strategies. What are the hedging strategies? Hedging is a risk management strategy used to protect against adverse price movements in currencies, stock, commodities, or other assets. What is the concept behind these hedging strategies? The concept is this: take an offsetting position to reduce potential losses. What are examples? A US-based investor holding European stocks may hedge currency risk by shorting Euro USD. Then what are the time frame for hedging strategy? It is between short to long term depending on exposure. So how does this hedging strategy works? Number one is that you need to identify your risk exposure, currency, commodity, interest rate, or market. Number two is that you need to enter an opposite position using derivative like futures, options, or swaps. Then number three is that the hedge offsets potential losses while limiting profit potential. Then what are the pros of hedging? Number one is that it protects capital from market volatility. Yes, so hedging protects capital from market volatility, and also it provides peace of mind for long-term investment. Then number three is essential for institutional traders and large portfolio. What are the cons or disadvantages of hedging strategy? Number one is that it reduces potential profit from favorable moves. Number two, it may involve additional costs like derivative, spread, and margin. Then number three is that it requires proper analysis and monitoring. Then the next thing is, what are tips for traders? What are tips for traders who are trading this hedging strategy? Number one is this: use option and futures for precise hedging. The next one is adjust hedge ratio based on market exposure. Then the next one is regularly review and update hedges to match portfolio risk. Are you getting my point right now? So in all these things that I've been explaining, all these things that I've been talking about, now I want us to to comparing the three strategies. Are you getting my point? So I have already write all of them out, comparing the two strategies. One, the strategy, their goal, their risk level, and their best use case. The first strategy is carry trade. Carry trade, their goal is to earn interest differential, and their risk level is medium, while it is best used for stable interest market. Then we have the second strategy, which is the arbitrage. Their goal is to exploit price inefficiencies, and their risk level is low risk and small profits, but the best use case is highly liquid and fast market. Then we have the hedging strategy, which is their goal is to protect against losses, and their risk level is low to medium. At the same time, it is best use case is portfolio or currency explosion. So in conclusion, advanced strategies like carry trade, arbitrage, and hedging allow traders and investors to maximize profit and manage risk in different market conditions. So carry trade leverages interest differential for steady returns, while arbitrage exploit pricing inefficiencies for low risk profit. Then hedging protect against adverse market movement. Then who are traders? Traders who understand and properly implement these strategies can enhance portfolio performance, reduce risk, and adapt to both stable and volatile markets. So if you can be able to understand and properly implement this strategy that I teach you, it can help you, enhance portfolio performance. It can help you reduce risk, and also it can help you adapt in both stable and volatile markets. I get my point right now. So let's continue with the next chapter or the next section on this my video, which is the algorithmic and automated trading, which is a complete guide to EAs and trading bots. So for those of you who doesn't know what is algorithmic and automated trading, I will explain to you in this section. In trading or in trading world, the trading world has evolved tremendously with technology. So algorithmic and automated trading has become a cornerstone to modern traders, enabling faster execution, emotion-free decision, and advanced strategies. In this section, we will explore what algorithmic trading is, how expert advisors how expert advisors and trading bots works, their benefits, risk, and tips for successful implementation. So what is algorithmic trading? If I may ask, algorithmic trading, also called algo trading, involves using computer program or algorithm to execute trades automatically based on predefined rules. These rules may include price level or pattern, technical indicators, time of the day or trading session, and also economic news releases. So algorithmic trading eliminates the need for manual execution, allowing traders to capitalize on opportunity instantly. So automated trading and bot trading. What are automated trading? Automated trading uses software known as trading bots to manage trades on behalf of the traders. Expert advisor or EA are custom program designed for platform like MetaTrader 4 or MetaTrader 5. Then trading bots are scripts or AI based program that can operate across multiple platforms. Then we have function. We have which automatically enter, modifies, and close trade based on rules given to the algorithm or the AI bot. How does it works, or how does this automated trading works? If you may ask, number one is that you need to define your trading rules. Yes, you need to define your trading rules, decide on indicators, entry or exit condition, stop loss, and take profit levels. Number two, program the bot or EA. Use a platform like MT4 or MT5 or Python based system if you're a programmer. You can find a programmer who will do it for you. Then number three is backtest or test your strategy against historical data to check performance. Then number four, deploy live. The bot execute trade automatically 247 based on your strategy. Are you getting my point? Right now, what are the advantages of algorithmic or automated trading? Because algorithmic automated trading have its own advantage. Number one, speed and efficiency. Bots can execute trade in milliseconds faster than humans. Two, emotion-free trading. It removes fear and greed from decision making. Number three, consistency. Trades are executed exactly according to rules, avoiding mistakes. Number 4, ability to trade multiple markets. Both can monitor and trade multiple instruments simultaneously. Number 5, backtesting. Allow testing strategy on historical data before risky real money. What are the disadvantages of algorithmic or automated trading? Because anything that have advantage also have disadvantage. Number 1 is technical failure. Power outages, connectivity issues, or platform error can affect trading. Number 2, over optimization. A strategy that works in backtesting may fail in live markets. Number 3, market conditions changes. So bots cannot adapt unless programmed to handle new scenarios. Then number 4, cost. High quality EAs and bots can be very expensive. Plus there may be subscription fees. Are you getting me? So the cost of building an EA or high quality bot is very, very expensive, and also it may have subscription plan attached to them. So we have popular algorithmic trading strategies. So popular algorithmic trading strategies are: algorithmic trading can implement a variety of strategy. Number 1 is trend following. So use moving averages, MACD or ADX to follow market trend. That is number 1. Number 2 is mean reversal or mean revision. Trade when market price move away from historical averages. Number 3 is breakout strategies. Automatically enter trades when price breaks support or resistance level. Are you getting my point? Then number 4 is news-based trading. Yes, react instantly to economic release or corporate news. Yes, of course. Then we have the 5th one, which is scalping. Execute multiple small trades in short time frame for quick profit. Yes, of course. Then we have tips for successful automated trading. Yes, I'm going to be telling you the tips or advices you need to follow for successful automated trading. Number 1 is start with a demo account. Yes, test your EA or bot in a risk-free environment. Number 2, backtest thoroughly. Use historical data to verify strategy performance. Then number 3, monitor performance. Even automated system require supervision. Yes, of course. You need to supervise your program because it requires supervision so that it will be working effectively. Number 4, use proper risk management. Yes, set stop loss and position sizing carefully to avoid blowing your trading account with automated trading. Number 5, keep it simple. Yes, keep it simple. Avoid overly complex bots that are hard to maintain. Yes, also update and optimize, which is number 6. Adapt your bot to changing market conditions regularly. Yes, so you need to always update your bot so that it can adapt to changing market conditions on a regular basis. So in conclusion, algorithmic and automated trading has revolutionized the way traders operate. EAs and trading bots offer speed, consistency, and the ability to trade emotion free. I get my point. Why they trade provide numerous advantages like efficiency, backtesting, and multi-market monitoring. They also carries risks such as technical failures and over optimization. So for traders willing to invest in time, programming, testing, and monitoring, algorithmic trading can enhance profitability, reduce stress, and provide an edge in the highly competitive market. But the most important thing is this: for someone who want to trade using trading bots, the first thing you need to do is that number 1 is that you need to understand your strategy. Are you getting my point? You need to understand your trading strategy, because if you understand your trading strategy, then you can be able to implement and execute your trading strategy into the algorithm or into the trading bot or the AI bot, whichever one you call it. Then it will help you through your strategy to be able to create that bot. Because if you do not understand trading, you can never understand how the automated trading or AI bots in trading works. So that is why you need to first of all understand how to trade without AI. Then know how good and how superior your trading strategy is, and how to refine your trading strategy. Then you can be able to use your trading strategy and make use of it in AI or in automated trading. Because you can't be trading automated market without even understanding how the market works or how your trading strategy works, because the AI bot or the AI trading works based on your strategy. So you need to have a good edge, or you need to have an edge in the market and be profitable manually before looking for a tool or before subscribing for bot. Understand? That is why these things, this type of trading are mainly used by advanced traders or the experienced traders. But why I decided to teach you is that so that you guys know that this kind of things are existing in the forex market. But don't be left, but don't be carried away by what you are seeing on the internet of or traders who are making use of AI bot to trade and make money. Yes, it is good. It is very, very less stressful, but you need to have experience on manual trading before diving straight into the automated or AI bot trading. Are you getting my point? So this is the section. This is the section of episode 7, and this is the end of episode 7. So I'll be jumping right after this episode 7. I'll be going to the next episode. Understand? So I'll go to the next episode, which is episode 8. I get my point. So stay with me. In the next clip, we will be teaching you the next topic, which is the episode 8. Thank you for sticking with me. Let's head over to episode 8 right now. Thank you. So hello guys, welcome back to my episode 8. So let's continue from where we stop. So this is the episode 8 of this very, very video of full forex trading course. So in this episode 8, I'll be talking about risk management, risk and money management in forex trading, which is the secret skill that separates winners from losers. So this episode 8 is talking about everything concerning risk management. I got my point right now. So let's head over and continue with the episode 8, because risk management is very, very important in trading. Because as a trader, if you don't have risk management, please don't be found yourself trading the market, because risk management is what separates the 5% among the 95% of traders. So for you to be among the 5% of traders who are making money in the market, you need to apply proper risk management and money management in your trading. So that is why this episode 8 is dedicated to risk and money management in trading the forex market, and also trading any other market, whether it is stock, crypto, or indices or commodity. No matter the kind of market that you are trading, risk management is very, very, very important and crucial. So let's continue. Risk management and money management in forex trading. The secret skill that separates winners from losers. Forex trading can change your financial life, but only if you master the one skill that truly protects your capital, which is risk and money management. So you can have the best strategy, the best mentor, or even most advanced trading tools, but without strong risk control, you eventually blow your account. In this section, we will break down everything you need to know about money management so you can trade confidently, protect your capital, and grow your account the smart way. So what is risk and money management in trading? Risk and money management refers to the rules and processes you use to protect your trading capital. Yes, risk management and money management refers to the rules and processes you use to protect your trading capital. Yes, of course. It helps you in keeping losses small. It helps you to grow your account steadily. It helps you to survive bad trading days, and also trade without fears or emotional stress. In simple words, risk management helps and keeps you alive in the market, while money management helps you to grow. So why many traders blow their account? Over 90% of traders fail, not because they don't know strategies, no, but because they ignore risk and money management. So what are the common mistakes? Common mistakes include trading without a stop loss. Yes, common mistakes include trading without a stop loss. The next one is trading risking too much per trade. Yes, of course. The third one is over leveraging. The fourth one is revenge trading. The fifth one is holding on to losses for too long. And also, the sixth one is adding to losing position. Every blown account has one thing in common: poor risk management. Yes, of course. Every account that is being blown in the financial market have one thing in common, which is the poor risk management. So let's continue. The 1 or 2% rule, which is your first line of defense, is a golden rule in forex trading, and is to risk only 1 to 2% of your total account on a single trade. Example: if your account is $500, 1% risk is $5, 2% risk is $10. It doesn't matter how perfect a setup looks. The market can do anything. Protect your account first. Use stop loss on every trade. Are you getting my point? A stop loss is your setback. Trading without it is like driving a car at high speed with no brakes. Benefit of using a stop loss. Number one is that it prevents emotional decisions. Number two is that it limits your downside. Number three is that it helps you calculate risk properly. Number four is that it keeps your strategy consistent. Then, professional traders always protect themselves. Only amateur trade without stop loss. So, every professional trader who are making money in the forex always protect themselves with stop loss. While the amateur who are newbies, who are beginners in this business, trade without stop loss, and it is very, very, very bad. So, always make use of your stop loss when trading the forex market. Let's talk about position sizing, which is the formula that controls everything. Position sizing helps you determine the exact loss size you use based on one, your account size, based on your risk percentage, and your stop loss distance. What is the formula for position sizing? Accounts times risk over stop loss in pips. So this protects your account during unpredictable market moves. The next thing is that never over leverage. Leverage can make you rich or destroy your account instantly. Many brokers offer leverage like 1:500 or 1:1000. This tempts beginners to open huge position, but professional traders keep leverage low and controlled. So as a beginner, don't be tempted to open a huge position because you are given a leverage of 1:500 or 1:1000. No, be a professional trader who keeps leverage low and controlled. Why? Because high leverage is equals to bigger position. Bigger position equals to bigger emotional stress, and bigger stress equals to bigger losses. So don't be found doing all these things that I'm listing at. Avoid making use of bigger position when trading high leverage. Are you getting my point? So let's continue. If you want to last in forex, avoid unnecessary leverage. Yes, of course. If you want to last in forex, avoid unnecessary leverage. Then let's talk about risk to reward ratio. Trade only when it makes sense. Yes, risk to reward ratio. Trade only when it makes sense. Risk to reward ratio (RRR) determines whether a trade is worth taking. Yes, a good risk to reward ratio is 1:2 or 1:3. Example is, if you risk $10, aim to make $20 or $30. This way, even if you win 4 out of 10 trades, you can still be profitable. That is how professional traders stay ahead. Are you getting my point? So the next thing is this: avoid revenge trading. Yes. What is revenge trading? Revenge trading happens when you lose money and try to make it back quickly. Yes. Revenge trade is all about when you lose money in the market and you want to make back the money immediately. This is dangerous because it can lead to these things that I'm about to list out for you. Number one, it can lead to overtrading. Number two, it can lead to emotional decision. Number three, it can lead to bigger losses. Number four, it can lead to account blowout. So when you lose a trade, walk away. Yes, when you lose a trade, walk away. Reset your mind. The market will always be there tomorrow. Yes, of course. When you lose a trade, walk away. Reset your mind. The market will be always be there tomorrow. The next thing is that diversify your trade. By this I mean, do not risk your whole account on one currency pair. Yes, of course. Do not risk your whole account on one currency pair. Spread out your trade or choose only the best setup. Avoid trading highly correlated pair at the same time. For example, Euro USD or GBP USD, USD JPY and Chef JPY, and at the same time AUD USD and New Zealander USD. All these things I'm listing out for you are correlated currency pairs that are correlated to each other. So you need to avoid trading high correlated currency pairs and at the same time. So that is why I was able to list all of them out for you. Euro USD and GBP USD are highly correlated. So you should not be trading two of them at the same time. GBP USD JPY and Chef JPY are highly correlated. So you should not be trading two of them at the same time. And AUD USD and NZD USD are highly correlated. You should not be trading two of them at the same time. I got my point. So if one move against you, the other will likely follow. That is the fact. If one is moving against you, if the one is moving against you, the other one will likely follow it immediately. So always trade with a plan. Yes, always trade with a plan. Risk and money management are useless without a solid trading plan. Yes, risk and money management are useless without a solid trading plan. Your plan should include number one, entry rules. Yes. Number two, exit rules. Number three, stop loss and take profit placement. Number four, maximum daily loss. Number five, maximum number of trades. Number six, your risk percentage. Yes, a plan makes you consistent. Consistent builds profit. Yes, a plan makes you consistent, and consistency builds profit. So the next thing you need to know is that keep your emotion under control. Yes, keep your emotion under control. Most bad decisions come from fear, comes from greed, comes from FMO, which means fear of missing out, and impatience. So risk management helps you control emotion by giving you structure and boundaries. When you follow your rules, emotions lose their powers. I get my point. The importance of journaling. A trading journal helps you track your mistakes, your winning traits, your emotion, your risk level, and your improvements. I get my point. That is it. Then professional traders rely heavily on journals to refine their performance. Then my final thoughts on this risk management is that risk management is the real strategy. Yes, of course. If you don't know it today. Risk management is the real strategy. Yes, of course. Risk and money management is the heart of successful trading. Strategies will come and go, but risk will control and protect you forever. Get the point right now. Risk and money management is the heart of successful forex trading. Strategy will come and go, but risk control will protect you forever. So if you want to become consistently profitable trader, number one, use a stop loss. Number two, risk 1 to 2% per trade. Number three, use proper loss size. Number four, maintain a good risk to reward ratio. Number five, control your emotion and stick to your plans. I understand. So these are the things that you need to follow if you want to consistently be a profitable trader. Then the next thing is this: Trading is not about how much you make. No, it is about how much you keep. Master risk management and profit will follow. Yes, of course. You need to master risk management, then profit will follow. It is very, very important. You need to master risk management, then profit will follow. Let's talk about risk to reward ratio in forex trading. The smart trader secret to long-term profitability. Yes, risk to reward ratio in forex trading is the smart trader secret to long-term profitability. I'm getting my point right now. So when it comes to forex trading, most beginners focus on interest, indicators, and strategies. Yet, the real secret behind consistent profitability lies on one simple concept: risk to reward ratio, RRR. This single principle is so powerful that it can even an average strategy into profitable one. It determines whether your trades make sense, whether your system is sustainable, and whether you can grow your account safely over time. In this context, or in this section, we will explain everything about risk to reward ratio, why it matters, and how to use it like a professional trader. So you need to ask yourself, what is risk to reward ratio? RRR. The risk to reward ratio is a comparison between how much you are willing to ask or how much you are willing to risk, which is loss, versus how much you aim to gain, which is the reward. Let me repeat it again. The risk to reward ratio is a comparison between how much you are willing to risk, which is loss, versus how much you aim to gain, which is reward. It is expressed as ratio such as 1:2, which means you are risking $10 to make $20. 1:3, meaning you are risking $10 to make $30. And 1:5, which means you are risking $10 to make $50. So a good risk to reward ratio means your potential reward is always greater than your potential risk. Let's go ahead. Why risk to reward ratio is so important? Yes, many traders think winning more trades automatically means making money. No, this is false. You can win 80% of your trades and still lose money if the risk reward ratio is bad. You can only win 40% of your trade and still be profitable if your risk to reward ratio is good. Example, let me give you an example because I love giving you an example for more clarity's sake. If you are risking $10 to make $30, that is 1:3. Even if you win just 3 out of 10 trades, your win is 3 times 30 is $90, and your losses is 7 times 10, which is $70. Your net profit is $20. So even with low win rate, you still make money. That is the power of proper risk to reward ratio. The formula for risk to reward ratio is calculating the risk to reward ratio is simple. Risk to reward ratio equals to potential reward divided by potential risk. So stop loss is 20 pips, for example, and your take profit is at 60 pips. That means divide your take profit, which is 60 pips, by 20 pips, which is your stop loss. It will give you 1:3. This means that you are aiming to earn 3 times more than you are risking. And the golden rule is this: always aim for risk to reward ratio of 1:2 or higher. Professional trader rarely takes lower than 1:2. Why? Because 1:1 ratio means you must win at least 50% of your trade just to break even. Are you getting my point right now? So because with 1:2 ratio, you only need to win 34% of your trade to stay profitable. While with 1:3 ratio, you only need to win 25% win rate to make money consistently. This is why high risk to reward gives you an advantage even when the market behaves unpredictably. Are you getting my point right now? So you need to ask yourself how to set risk to reward the right way. Yes, you need to ask yourself how to set risk to reward ratio the right way. And here is a simple step-by-step method for you to set the risk to reward ratio the right way. Number one, or step one, is identify your stop loss level. Yes, place your stop loss where the trade idea becomes invalid, not too tight and not too wide. Number two, identify your take profit level. Yes, make use of market structure, support or resistance, Fibonacci level, or previous highs or lows. Yes. Number three, or step three, calculate the risk to reward ratio. If reward is less than risk, then the trade is valid. But if the reward is greater than risk, then avoid the trade. Step 4, stick to the plan. Do not reduce your risk. Do not reduce your take profit or widen your stop loss out of fear. This destroy your ratio. Then you need to ask yourself this question: how risk to reward ratio increases your discipline? Yes. A proper risk to reward ratio helps you in this following. Number one, helps you avoid emotional decisions. Number two, helps you avoid overtrading. Number three, helps you avoid chasing losses. Number four, helps you stay selective and patient. Number five, helps you build consistency. And number six, helps you reduce stress. So if you force to take only high quality trade, just like professional traders, which means that bad risk to reward ratio is to avoid. So these low ratio are very dangerous. For example, if you are trading 1:1, break even trading. Now, if you are trading 1:0.5, that means you are risking 10 to make 5. Then if you are trading 1:0.2, that means you are risking $10 to make $2. It doesn't make sense. This means that you are risking more than you stand to gain, and it doesn't make sense. So, and it will make you to lose your capital very, very fast. So this inevitably leads to blowing account. Like, yes, of course. How can you be risking more than your reward? It doesn't make sense. So your risk, you need to be one, and your reward need to be high. Are you getting my point? So you cannot be risking more than your reward. No. So your reward needs to be higher than your risk. That is the short and simple short of all this thing. Are you getting my point? So risk to reward and win rate, the perfect combination. So yes, of course. So you need to understand the risk to reward and your win rate, because these are the perfect combination. Your trading success depends on the relationship between your win rate, the next, your risk to reward ratio. And here is the simple performance guide to these things. So as you can see, winning rate and the risk to reward ratio needed to be profitable. If your winning rate is 90%, that means that you need 1:0.5% risk to reward ratio. And if your winning rate is 70%, that means you need 1:1 winning rate. Then if your winning rate is 50%, you need 1:2. Then if your winning rate is 40%, you need 1:2.5. Then if your winning rate is 30%, you need 1:3. And if your winning rate is 1:4, and if your winning rate is 25%, you need 1:4 risk to reward ratio. So even with a low win rate, a higher risk to reward keeps you profitable. Yes, even with a low win rate, a higher risk to reward still keeps you profitable. Now, let's head over to the real life example of using risk to reward ratio in Forex. Let's continue. Let's say you are trading the Euro USD, and the entry, which is you are buying at 1.1000. Then your stop loss is below support at 1.09800, and your stop loss is 20 pips, and your take profit is near resistance at 1.10600, which is 60 pips. The risk to reward ratio is that you divide 60 pips, which is your take profit, by 20, which is the risk that you are willing to take, and it will give you 1:3. So this is a quality trade because the setup aligns with market structure. Your potential risk to reward is 3x your risk. And even if you read long 7 times, and out of 7 times, you just got it still profit, yes. So even if you are wrong 7 times out of 10 times, you are still in profit. This is how smart traders think. Are you getting my point? So the biggest mistake traders make with risk to reward ratio, yes. So in this section, I'm going to be telling you the biggest mistake traders make in this risk to reward ratio. Why? Many traders move their stop loss further away when price moves against them. Yes. Many traders move, or many beginners, I mean, even some advanced traders always do sometimes, move their stop loss further away when the price move against them. This increases risk and destroy their ratio completely. Professional traders never do this. They accept losses quickly and wait for the next opportunity. Yes. How to improve your risk to reward ratio immediately. So you need to ask yourself, how can I improve my risk to reward ratio immediately? So here are the things you need to do to improve your risk to reward ratio immediately. Here is number one step is trade with the trend. Yes, trade it is with the trend because they are saying that in trading, your trend is your friend. Then the second one is enter after pullback to reduce stop loss distance. Yes, enter after a pullback to reduce a stop loss distance. Yes. Number three is use higher time frame to find a bigger target. Yes. Number three is use higher time frame to find a bigger target. Yes. Number four is keep stop loss safe but tight. Yes. Number four is keep stop loss safe but tight. Number five is never chase trades. Wait for quality setups. Yes. Number five is never chase trade. Wait for quality setups. Number six is combine risk to reward ratio with proper risk management. Yes, you need to combine risk to reward ratio with proper risk management. Then let's continue. Even small improvement in risk to reward ratio can dramatically increase your profitability. Yes, even small improvement in risk to reward ratio can dramatically increase your profitability if you don't know. My final thoughts on risk to reward ratio. Let's continue. Risk to reward ratio is your profit engine if you doesn't know. Yes, the risk to reward ratio is not just a concept, it is the backbone of successful forex trading because number one, it protects you from large losses. Number two, it increases your profitability. Number three, it allows you to trade with confidence. Number four, it helps you survive long term. So if you want to trade like a professional, make sure your rule never make sure that this rule is with you. Never take a trade below 1:2 risk to reward ratio and aim for 1:3 or better. Do this consistently and your trading account will thank you. Are you getting my point? So let's talk about position sizing in forex trading, which is the hidden formula behind which is the hidden formula behind professional level risk control. Yes. Are you getting my point? Position trading, yes. Position sizing in trading forex is the hidden formula behind professional level risk control. So many traders doesn't apply a good position sizing. They are over maxing their account. So in this section, I will guide you on how to use position sizing in forex trading effectively. Are you getting my point? Let's continue. So in forex trading, beginners beginners are often obsessed with over interest, strategies, indicators, and candlestick pattern. But professional traders, they focus heavily on position sizing, the engine of proper risk management, and the real key to consistent profitability. Position sizing determines how many lots you should trade based on your risk tolerance, account size, and stop loss distance. If you ignore this, your account will suffer, and if you master it, your account will grow steadily. Are you getting my point? So position sizing determines how many lots you should trade. If you ignore it, your account will suffer, and if you master it, your account will grow steady and safely. So in this section, On this episode, I will explain everything you need to know about position sizing in forex trading. Let's continue. What is position sizing? Position sizing is the process of deciding how big your trade should be. So in forex, this means that calculating the right lot size you should use for every trade depending on your your account size balance. Number 2, how much you want to risk. Number 3, the size of your stop loss. And number 4, the currency pair you are trading as. Are you getting my point? It is not about trading big, it's about trading smart. Position sizing helps you survive losing streaks, protect your capital, and stay consistent. Why position sizing is so important? Number 1, even the best strategy in the world can fail if your lot size is too large. A bad trade with a huge lot size is an instant disaster. Yes, of course. So let me repeat it again. Even the best strategy in the world can fail if your lot size is too large, because a bad trade with a huge lot size is an instant disaster. So here is why position sizing matters. Yes, of course. So you need to know why position sizing matter. You need to know why it is very, very important to have a position sizing. Number 1, protect your account. It prevents you from risking too much on a single trade. Yes, of course. It prevents you from risking too much on a single trade. Number 2, it reduces emotional stress, meaning smaller calculated risk helps you to stay calm and disciplined. Are you getting my point? Yes. The next one is it helps you, makes your trading consistent, meaning your result becomes predictable and organized rather than random. The next one is it helps you survive losing streaks. So no matter how good you are, losing streaks will always happen as a trader. You need to be ready for it, no matter how good you are. And also, position sizing keeps your account safe during this period. Yes, of course. So the next one is create long-term profitability. Smart traders focus on managing risk and not chasing big wins. So the position sizing formula you need to know. So here is the simple formula every forex trader should memorize, which is position size in lots equals to account balance times risk percentage over stop loss in pips times value. Let me break it down. Account balance is how much money you have. Risk percentage is the percentage you are willing to risk, whether it is 1 or 2%, which I highly recommend the risk between 1 to 2%. Then number 3 is stop loss, distance in pips between entry and stops. And number 4 is pip value. How much pip is what depending on pair and the lot size. So most traders risk 1 or 2% of their account on a trade. Are you getting my point? For example of position sizing and simple and clear. Let me give you an example of position sizing that is very simple and clear. Let's say that your account balance is $1,000 and the risk per trade is 2%, which is $20, and your stop loss size is 50 pips. Pip value for 0.01 loss size is 10 cents per pip. Let me give you this instance. Step 1 is that calculate the total amount you are risking, and you are risking 2% of $1,000, which is $20. Step 2 is divide by stop loss cost. So cost per pip is 10 cents per pip. So, and that cost is 10 pips, which is 10 cents by pips and by 50 pips. So total cost will equal to 50 pips times 10 cents. It equals to $5 per 0.01. I get my point. Then step 3 is determine lot size. You can risk $20 each on 0.01, risking $5. So $20 divided by 5, it will give you 4. 4 times 0.01. So your final position sizing is 0.04. This is how professional size. This is how professional size their position logically and safely. So what does this happen? This thing helps you, to put your position sizing into perspective. Also you can do it using your position sizing calculator. That is on so many platforms. Are you getting my point? So, but this position sizing is very important for you to know the amount you are risking, or the position sizing or the loss size you are putting on the trade at a time. Because if you put a huge loss size on your trade, you can blow your account very fast. That is why you need to calculate your position sizing very well before placing your trade. You understand? So let's forget. Let's not forget, and let's continue. Never guess your loss size. Always calculate it. Yes. Never guess your loss size. Always calculate it. Most traders choose loss size based on emotion. Yes. By this, for example, I feel confident today. The last trade was a loss, so I will increase my size. This setup looks perfect. Let me use a bigger lot size. So this randomness is dangerous and leads to blown account. So don't choose your position sizing based on your emotion. No. Choose your position sizing based on calculation and accuracy. Are you getting my point? Yes. Because professional traders never guess. No. They calculate their position before entering the market. Yes, of course. Professional traders, they never guess. They calculate their position size before entering the market. The next one is factors that affect position sizing. Yes, because there are so many factors that affect position sizing. Yes, because position sizing is not the same for every trade. There are major factors that we must consider. Number one is account size. Yes, the larger your account, the more you can safely risk, but the same percentage apply. For example, $100 account is equals to risking 1%, which is $1. Then $1,000 account is risking 1%, which is equals to $10. Then $10,000 account risking 1% is equals to you are risking $100. Number two, risk per trade. Most traders use 1% risk, which is safe, while people use 2% risk, which is moderate, and while some people use 3% plus risk, which is aggressive and not recommended. So that is why I always recommend you to make use of between 1% and 2% per trade when risking. Are you getting my point? Then number three, stop loss distance. A tight stop loss equals to small risk and larger position possible, while a wide stop loss equals to larger risk and smaller position needed, and small position needed. This is why entry at the wrong spot destroy your risk management. Are you getting my point? So you entering at the wrong spot destroys your risk management. Number four is currency per pip value. Yes, pip value differs. Euro USD, GBP USD have stable pip value, but GPY pairs like USD JPY or Euro JPY pip value are different. Exotic currency pairs have higher volatility, so your position sizing must adapt. You must adapt to different currency pairs. Are you getting my point right now? So let's continue. What are the common mistakes traders make with position sizing? Yes, of course. You need to know common mistakes that traders make in position sizing. And here are the common mistakes that blow account. Number one is using the same loss size every day, on every trade. Using the same loss size every trade. Market condition changes. One size does not fit all. The next one is increasing loss size after losses. Revenge trading. Yes, this leads to emotional and impulsive decision. Number three is ignoring stop loss distance. If your stop loss is too wide, then the loss size must be smaller. Then number four is over trading. Huge loss size makes your account unstable and emotional. Then number five is risking more than 2% per trade. This creates big drawdown that are hard to recover from. So choose to help you in position sizing. If you don't want to calculate your position sizing manually, then use these things that I'm about to list to you. Number one is use position sizing calculator, which is in online. You can get it in online platforms. Like for example, you can get it in baby pips. So search for baby pips position sizing calculator. You can make use of that if you don't want to calculate it manually. Number 2, make use of your MT4 or your MT5 indicator. And also make use of your risk management apps. And also make use of trading journal and your spreadsheet. Are you getting my point? That is it. Then smart traders use tools. Lazy traders take guess. So traders who are smart uses tools, while lazy traders take guesses, and traders who are always guessing in the market end up losing their capital. Then let's continue. How position sizing improve your trading instantly? So how can position sizing improve your trading instantly? Let's continue. Once you start using proper position sizing, number 1, your stress reduces. That is number 1. Number 2, your losses become manageable. Number 3, your account stops blowing. Number 4, your consistency improves. Number 5, you start thinking like a professional. And number 6, you stop trading based on emotion. So once you start using proper position sizing, these are the things that is going to happen to you. Your stress will reduce. That is for sure. Your losses will become manageable and you'll be okay with your losses. Number 2, you will stop blowing. Number 3, you will stop blowing your account. It's very, very important. And also, your consistency will begin to improve. You will notice a bit more of consistency. The number 5 is that you will start thinking like a professional. At the same time, you will stop trading based on emotion. You will stop trading based on greed. You will stop trading based on fear. You will stop trading based on sentiment. Are you getting my point? So, position sizing is not glamorous, but it is very, very powerful. Are you getting my point? Position sizing is not glamorous, but it is very, very powerful. So, my final thought on this position sizing is this. Position sizing is your shield against losses. Yes, of course. For those of you who doesn't know, position sizing is your shield against losses. So successful trading is not just about taking big risks. It is about controlling your exposure and managing your capital like a professional. Yes, of course. So with proper position sizing, your account becomes safer, your result becomes consistent, your mindset becomes stable, and your journey becomes long term. Yes. Remember this rule. Remember this rule that I'm about to say. Position sizing is the difference between gambling and trading. Yes, of course. Position sizing is the difference between gambling and trading. Master this skill and your entire trading career will transform. So let's talk about the next topic, which is stop loss and take profit in forex trading. Your ultimate guide to smart trade management. So stop loss and take profit in forex trading is the ultimate guide to smart trade management. In the world of forex trading, success isn't about finding the perfect entry. It is about managing the trade once you are inside it. And that is why stop loss and take profit comes in. So these two tools are essential for every trader who want to protect their capital, control their emotion, and grow their account consistently. In fact, professional traders rely on stop loss and take profit level more than any indicator. So in this section, we will explain everything you need to know about stop loss and take profit, why they matters, and how you can use them effectively. What is stop loss? A stop loss or SL is a preset price level where your trade will automatically close if the market moves against you. In simple terms, stop loss protects you from losing too much money. Instead of watching your trade drop in bigger losses, the platform closes it automatically. Then you need to ask yourself why you need a stop loss. Number 1, it protects your capital. It prevents emotional decision making. It limits your maximum risk per trade. And at the same time, it helps you remain disciplined. And also, it allows you to trade without fears. Are you getting my point? So, beginners who avoid using stop loss eventually blow their account. And that is the truth. Professionals always use stop loss. Stop loss. What are types of stop loss in forex trading? There are different types of stop loss in forex trading. Number one is fixed stop loss, a specific price level you set based on structure of or strategy. Example, stop loss equals to 30 pips. Number two is trading stop loss, moves with the price and as it progresses in your favor. Number three, let me give you an example. If the market goes up by 20 pips, the stop loss moves up by 20 pips. This locks in profit while allowing the trend to continue. Number three, volatility based stop loss. Set depending on how volatile a pair is after using ATR, average to range. The more volatile the market, the wider the stop loss. So what is a take profit? A take profit is a preset level or a preset price level where your trade will automatically close with a profit. In simple terms, take profit helps you secure profits before the market reverses. It ensures you don't lose your gain out of greed or hesitation. And you need to ask yourself this question: why you need a take profit? It protects your winnings. That is number one. It prevents overholding. That is number two. It keeps your risk to reward ratio consistent. That is number three. It removes emotional decision. That is number four. And it helps you grow your account steadily. That is number five. So without take profit, many traders watch winning trade turn into losing one. Yes, of course. Without take profit, many traders watch winning trade turn into losing ones. So where to place your stop loss and take profit? Setting stop loss and take profit accurately is an art, and here are the best place to set them. How to set your stop loss? Number one, below support or above resistance. If you buy, place stop loss below support. If selling, place stop loss above resistance. This keeps your stop loss safe and logical. Number two, using market structure. Place stop loss beyond recent highs or lows. Market structure helps you know where your trade idea becomes invalid. Number three, using ATR or volatility management. ATR tells you how much a pair normally moves. Place your stop loss outside the normal price noise. Number four is avoid tight stop loss. If the stop loss is too tight, normal frustration will trigger it. Then let's continue. How to set your take profit. At a major support or resistance level, this level often stops the market, which is called perfect for locking profit. Number two is using Fibonacci extension. Fibonacci helps you to identify profit targets during trend. And then using risk to reward ratio. Aim for 1:2, which is good, 1:3, which is better, and also 1:5, which is excellent for trending market. Example, if stop loss is equal to 20 pips and your stop loss is equal and your take profit is equal to 40 to 60 pips. Number four, based on market sentiment. If the market is trending strong, you can set bigger stop loss. You can set bigger take profit. Stop loss and take profit work best together. So both stop loss and take profit create a balanced trade. Why? Because stop loss protects your downside and take profit locks in your upside. So a complete trade plan includes both. Professional traders never open a trade without knowing where to exit if wrong and where to exit if right. This structure builds confidence and consistency. Are you getting my point? And here are the biggest mistakes traders make. Number one is not using stop loss at all. And what does it mean? It is guaranteed way to blow an account. Number two, placing stop loss too close. What will happen? Market noise will hit your stop loss repeatedly. Number three, moving stop loss further away. What will happen? It increases your risk and destroy your discipline. Number four, closing trade too early due to fear. What will happen? This ruins your risk to reward ratio. And number 5, avoiding take profit because of greed. What will happen? The market often reverse after hitting key levels. So you need to avoid these mistakes because these mistakes can transform your trading. Yes, of course. Once you can be able to avoid these mistakes, it can transform your trading. Then let's continue. How stop loss and take profit improves your emotion and discipline. So you need to ask yourself, how does stop loss and take profit improves your emotion and discipline? It's a very, very important question you need to ask yourself. How does stop loss and take profit improves your emotion and discipline? Let's continue. With stop loss, 1, there is no fear. With stop loss, number 2, there is no panic. Number 3, with stop loss, what if? There's no what if when you're using stop loss. Number 4, if you have stop loss, no holding losing trade too long. Yes, of course. Then if you have take profit, with take profit there is no greed. Yes, of course. With take profit there is no overconfidence. With take profit there is no hesitation. And with take profit there is no decision stress. So your mind becomes clear because your exit has already been predefined. So let me give you example of perfect stop loss and take profit setup. Like I'll always give you example. Let's say you are buying the Euro USD at the entry price of 1.10000 and the stop loss is at 1.09850, which is 15 pips below strong support, and take profit is 1.10300, which is 30 pips at the next resistance. This gives a risk to reward to 1:2 risk to reward ratio, which is ideal. You lose small if wrong and you win big if right. So this is how consistent traders make money. Then my final thought on this is this: stop loss and take profit are best friends in forex. Stop loss and take profit are not just tools. No, they are the foundation of professional trading. They help you protect your capital. Stop loss and take profit helps you protect your capital. It helps you protect your emotion. It helps you trade confidently. Stop loss and take profit helps you maintain discipline. Stop loss and take profit, helps you build long-term consistency. Also, stop loss and take profit helps you to become a profitable trader. So if you want to succeed in forex, make it as a rule to never enter a trade without a stop loss and take profit. Yes, of course. I will repeat it again. If you want to succeed in forex, make it a rule: never enter a trade without a stop loss or take profit. Once you master them, you will finally feel in control of your trading journey. So let's continue from the section 1, which is position sizing in forex trading, which is the hidden formula behind smart trading. Position sizing is one of the most powerful but underrated concepts in forex trading. Many beginners blow their account not because of bad strategies, but because they use the wrong lot size. If you want long-term success in forex, you must master position sizing. It determines how much you should risk on each trade based on your account size, risk percentage, and stop loss distance. Without it, even the best strategy will fail. What is position sizing? Like I've already explained further. Position sizing is the method of calculating the correct loss size for each trade so that you risk only what you can afford to lose. It answers the question, how big should my trade be? Instead of trading randomly or emotionally, position sizing gives you structure to your risk management. Why position sizing is crucial? Bad position sizing leads to overtrading, overleveraging, uncontrolled losses, emotional trading, and account being wiped out. But good position size trading your account helps you remain consistent even during losing streaks. The formula for position sizing is that The professional formula for position sizing is position size equals to account times risk percentage divided by stop loss in pips. For example, account size is $500 and your risk is 2%, which is $10, and your stop loss is 20 pips. Position size equals to $10 divided by 20 pips, which is your stop loss. It gives you $0.50 per pip, which is equals to 0.05 loss size, which is the micro size, which is the micro loss size. The power of calculating your loss size. Let loss size matter because number one, largest loss increases risk. So larger loss size increases risk. Small loss size reduces stress, and proper loss keep your trading stable. Trading without calculating your loss size is gambling. Take it from me. Trading without calculating your loss size is gambling. Tools for position sizing. To make it easier for you, make use of position sizing calculator, trading view tools, MT4 or MT5 script, or mobile trading calculator. This helps you stay consistent and avoid mistakes. Then the next thing is this: how position sizing protects you. With proper position sizing, if you lose 10 trades in a row, your account remains safe. For example, you risk 1% per trade on a $1,000 account. Loss after losing 10 trades is $100. You still recover $900 to recover. So you still have $900 to recover. But if you risk 10% per trade, after 10 losing trade, $651, you only have $341 left. The difference is huge. I understand. So my final thought on this is this: position sizing is the backbone of Forex risk management. Without it, consistency is impossible. Master it, and your trading will transform overnight. Are you getting me? So let's head over to the section 2, which is the stop loss and take profit in Forex, your ultimate guide to smart exit. Every profitable Forex trader knows this truth. How you exit a trade is more important than how you enter it. Yes, of course. Understand it. How you exit a trade is more important than how you enter it. So, stop loss and take profit are the most essential tools for controlling risk and securing profit. If you ignore them, you are trading blindly. So in this section, we will help you understand what tools and how to use them effectively. What is a stop loss? A stop loss or SL is a protective order that automatically closes your trade when the price hits a certain level against you. It prevents small losses from becoming big ones. Why do you need a stop loss? Number one, protect your capital. Yes, of course. Control your capital and protect it. It also helps you to control your emotions. Also, it helps you to prevent account blown out. It ensures discipline, and also it helps you calculate risk properly. So trading without stop loss is like driving a car without brake. What is a take profit? A take profit is an order that automatically closes your trade when price reaches your profit target. It locks in gain without requiring you to shift in front of your chart. Then what are the benefits of take profit? Number one benefit of take profit is that it removes emotional decision in trading. Yes. And also it helps you to stick to your plan. Also, secure profits quickly, and at the same time helps you to eliminate greed. Are you getting my point? So let's continue. Good traders respect their take profit. How to use take profit? So how to use stop loss and take profit properly? Number one is that place stop loss beyond market structure. Yes, your stop loss should sit outside your support and resistance, outside your trend line, outside your swing high or lows, and outside the liquidity zone. A proper stop loss protects your trade idea, which is number one. Number 2, place a take profit at logical level. Your TP should be based on previous high or lows, major zones, Fibonacci levels, and trend targets. Never set take profit at random, using stop loss and take profit to build risk to reward. Good traders never take a trade unless the risk to reward is 1:2 or better. Example, your stop loss is 20 pips and your take profit is 40 pips, which is that your risk to reward ratio is 1:2 and it is very, very ideal. This ensures long-term profitability. So what are the common mistakes to avoid as a trader? Number 1, no stop loss. Always make use of your stop loss. Moving stop loss further away. Don't try it as a trader. Closing trade before take profit. Setting stop loss too tight. And also setting take profit unrealistically far. This destroy trading account. Be very, very careful. My final thought: stop loss and take profit are your trading guardrail. Use them properly and your trading becomes structured, safe, and profitable. I get my point right now. So let's move ahead to section 3, which is risk per trade, the 1% or 2% rule, which is the key to survival in forex trading. So the 1% to 2% rule is one of the most important principles in forex trading. It protects your account from large drawdown and keeps you in the game long enough to become profitable. Many beginners blow accounts simply because they risk too much per trade. So in this section, I will explain why risking 1 to 2% per trade is a game changer. So what is 1:2 rule? What is 1:2% rule? The 1:2% rule means never risk more than 1 to 2% of your account balance in a single trade. This includes the lot size, your stop loss distance, and market volatility. Let me give you an example. If your account is $1,000 and your 1% risk is $10 and your 2% risk is $20, this ensure you stay safe during the losing streaks. While risking small is powerful. Why risking small is very powerful as a trader. Number 1, protect your capital. Your job as a trader is simple. Don't lose money. Small risk keeps your account healthy. Number 2, helps you survive losing streak. Every trader loses. Even great trader loses 40% of that 50% of the time. If you risk too much, a fewer bad trade will wipe away all your account. That is very, very important. So don't risk too much in your account. Also, reduce emotional stress. Small risk equals to calm mind. Big risk equals to fear, greed, and panic. A calm trader is a better decision maker. Are you getting my point? Example, risking 10% versus 1%. Let me give you an example so that you understand what I mean. Imagine you lose 10 trades in a row, risking 10% per trade. Your account size is $20. That means after 10 losses, you're only left with $349 left. But if you are risking 1% per trade and you have a $1,000 account, after 10 losses, that means you still have $904 left. So the difference is massive. When you use 1% and when you use 2%, you use 1% when market is high risk, and when you are new in the market, and when you are on losing streaks, and also when you are trading the news. Then when should you use 2%? You should make use of 2% when you are confident in your trading setup and when your market structure is clear, and at the same time when you have a good win rate statistics. Are you getting my point right now? So ask yourself, why professionals never risk more than 2%? So you should ask yourself this question: why do professional traders never risk more than 2% of their entire capital? Here is why. Professional traders stay in the game for years because they protect their capitals. They do not chase big wins. Are you getting my point? They focus on slow and steady growth. The market reward discipline and not greed. Here is my final thought. The 1 to 2% rule is the foundation of forex money management. So it keeps you safe, stable, and confident. Follow it strictly, and you will see a big improvement in your trading consistently. Understand? So now let's talk about diversification in forex trading, which is the smart strategy that reduces risk and increases stability. Let's go. Many traders or many new traders focuses heavily on strategy, entries, indicators, and sharp pattern. But there is one principle that quickly protects your capital, stabilizes your results, and reduces the emotional stress of trading, which is diversification. So what is diversification, if you may ask? Diversification is a powerful risk management tool used by professional traders, hedge funds, portfolio managers, and institutional investors. When applied properly, it ensures that no single loss can wipe out your account. In this section, we will break down exactly what diversification is, why it's important, and how to apply it in your forex trading. Let's continue. What is diversification in forex trading? Diversification in forex trading means spreading your risk across different currency different assets, currency pairs, strategies, or time frame, rather than putting all your money into a trade or one setup. In simple terms, don't put all your eggs in one basket. Do you understand me? Instead of relying on a single currency pair or one type of strategy, you spread your exposure so that if one area performs badly, the others can balance it out. Why diversification matters in forex trading? So you need to ask yourself this question: why diversification matters in forex trading? Number one, forex is highly volatile and unpredictable. Even the strongest setup can fail due to 1. News release, 2. Geopolitical event, 3. Unexpected market manipulation, 4. Market correction, 5. Sudden trend reversal. Why? Because diversification helps you 1. Protect your account by reducing the impact of a single losing trade or currency pair. What are the key benefits? And the key benefits includes 1. Low overall risk, 2. Smoother equity curve, 3. Less emotional stress, 4. Fewer larger drawdowns, 5. Better long-term performance. In short, diversification creates stability in an unstable market. Type of diversification in forex trading. There are several ways to diversify your trading. Professional traders often combine them to build a strong risk control portfolio. 1. Diversify across currency pairs. Instead of trading only one pair like Euro USD, you trade multiple non-correlated pair. Example, Euro USD, USD JPY, Canadian Dollar JPY, AUD NZD, and GBP Swiss francs. Even if one pair goes against you, the other may move in your favor. Avoid correlated pairs such as Euro USD and GBP USD, AUD USD and NZD USD, and USD JPY and Chef JPY. All these currencies that listed are for you. They are correlated. They are highly correlated. So avoid trading them together. I got me. So because trading correlated pairs double your risk because they often move in the same direction. Diversifying across market condition, which is number 2. Some strategies work best during trending period. Some work during ranging market. Some works in breakout. Some works in pullbacks. While some works in high volatility, and while some works in low volatility. Using more than one trading approach gives you a chance in profit. Different environment. What I go? And do you understand? So using more than one trading approach gives you a chance in profit in different environments. Do you understand? So let's continue. Example: trade following strategy for trending markets, range strategy for sideways market, and breakout strategy for volatility spike. This prevents long-term period of losses when one strategy stops working temporarily. Number 3, diversifying across time frames. Trading multiple time frames reduces your reliance on just one market views. For example, high time frame trades swing trading, lower time frame trades scalping or day trading. This allows you to benefit from both long-term trends and short-term moves. Number 4, diversifying across trading sessions. Forex have different level of volatility depending on the session. We have the London section, we have the New York section, and we have the Asia section. Instead of trading only one session, you can diversify across the ones that fit your strategy. Example, trend trades during London, breakout trade during the New York, and range trade during the Asia. This spread your exposure and capture more opportunities. Number 5, diversifying across assets or classes. While primarily a forex trader, you can simply diversify using gold, which is the XAUSD, silver, which is the XAGUSD, oil, which is the US oil, indices like NAS 100, US 30, and S&P 500. Also, you can diversify using the cryptocurrency like BTC USD or the Ethereum USD, because many forex traders use gold and indices for additional income streams. I get my point. So let's continue. How much should you diversify? The sweet spot. Diversification is powerful, but you should avoid over diversifying. Trading too many pairs or strategy can confuse you, increases mistake, reduces focus, and lead to poor execution. The goal is smart diversification, not scattered trading. Recommending sweet spot like 4 to 7 currency pairs, 1 to 3 strategies, and 2 to 3 time frames. Yes. So I recommend you to only trade 4 to 7 currency pairs, 1 to 3 strategies, and 2 to 3 time frames only. This gives you variety without overwhelming yourself. Are you getting my point? So what are the common mistakes traders make with diversification? Because there are common mistakes that traders make with diversification. Number 1, trading many correlated pairs. Yes. For example, you will see somebody or you will see a trader trading, he will be trading Euro USD, GBP USD, AUD USD often, and they often move in the same way. So this is not diversification. It is duplicating your exposure in the market. Are you getting me? Let's continue. Number 2, running too many strategies. One strategy executed well is better than 10 executed poorly. Are you getting me? One strategy executed well is better than 10 strategies executed poorly. Number 3, overtrading. Poor diversification is not an excuse to take unnecessary trade. Number 4, ignoring risk per trade. Even with diversification, follow the 1 to 2% rule. Number 5, trading assets you don't understand. Always master a pair or asset before trading it to your portfolio. A simple example of a diversified forex portfolio is here in a safe and balanced diversification structure, which is currency pair, Euro USD, which have low spread, the USD JPY, which is safe haven, the AUD CAD, which is cross pair, and the GBP chef, which has less correlation. What are the strategies? Trend following for major pairs, range following for cross pairs, and also breakout strategy for high volatility section. Then what are the time frames for these things? 1 hour for direction, 15 minutes for entry, and 4 hours for trend bias. This structure keeps your trading organized, balanced, and stable. My final thought on diversification is this. Diversification is the shield that protects traders. Diversification is not just a risk management tool, but it is a survival tool. It helps you in the following ways. Diversification helps you to manage unpredictable markets. Diversification helps you to avoid massive drawdown. Diversification helps you stay emotionally stable. And diversification helps you to achieve long-term consistency. And at the same time, Diversification helps you to trade with confidence. Smart forex traders do not depend on one pair, one strategy, or one market condition. No, they build a balanced approach that protects their capital while growing it steadily. So if you want to trade like a professional, follow this principle. Build a diversified trading portfolio. Your future self will thank you. I get my point right now. So let's head on to the full topic on this position sizing in forex trading. So position sizing in this forex trading is where the smart traders formula for controlling risk and maximizing profit. So in forex trading, most traders focus on strategies, indicators, and entries, but the real professional knows that position sizing is what determines long-term survival. Position sizing tells you how much of a currency pair to trade based on your risk tolerance, account size, and stop loss distance. It is the difference between traders who wipe out their trade and traders who grow it consistently. What is position sizing? Position sizing is the process of calculating the exact loss size you should use in a trade to control your risk. It answers the question, how big should my trade be? Instead of guessing or using random loss size, professional traders calculate their position size using math, not emotion. Why position sizing matters? Because proper position sizing helps you to protect your account from big losses. Proper position sizing helps you to stay consistency. Proper position sizing helps you to avoid blowing up after a bad few trades. Also, proper position sizing helps you to control your leverage safely. Also, proper position sizing helps you to trade with confidence. Also, proper position sizing helps you to manage your risk effectively. So, a good strategy with bad position sizing becomes useless. But when a simple strategy with good position sizing can be profitable, because even a simple strategy with a good position sizing can be profitable. The formula for position sizing is simple, and here is the position sizing formula. Position size equals to account size times risk percent plus stop loss in pips. So example, your account size is $1,000 and your risk per trade is 2%, which is $20. Then your stop loss is 40 pips. What does it mean? Your position size is $20 divided by 40 pips, which is 0.50 cents per pip. So it is equals to 0.05 lot in micro lot size. So this means that you can lose $20 in a trade if you hit your stop loss. So common position size types are, we have standard lot, which is $10 per pip movement. We have mini lot, which is $1 per pip movement, and we have 10 cents per pip movement, which is micro lot. So beginners should trade micro or mini lot for safety. Here is how position sizing saves traders. Imagine two traders, trade A and trade B, where trade A randomly uses one lot per trade and trader B uses only 2% of the account. After 10 losing trade, trader A blow the account. Trader B still have enough capital to recover. This is why professionals never trade without calculating their position size. My final thought on position sizing is this. Position sizing is the backbone of money management. It protects your capital, control your emotion, and give your strategy space to perform. So if you want to trade safely and profitably, calculate your lot size every single time. Are you getting my point? If you want to trade safely and profitably, calculate your lot size every single time. Let's head over to number 2 topic, which is the stop loss and take profit. Stop loss and take profit, the two tools that protect and grow your forex account. In forex trading, you don't control the market, but you do control your risk. The two most important tools for this are stop loss, which is the SL, and take profit, which is the TP. These two protect your capital, lock in profit, and eliminate emotional decision making. What is a stop loss? A stop loss is a protective order that automatically closes your trade if the market moves against you. It prevents small losses from being turned into catastrophic ones. Why you must always use a stop loss? It protects you when the market moves unexpectedly. It protects emotional panic, and it saves you from blowing your account. And also, it allows consistent risk management. Professional traders, what do? Professional traders never trade without a stop loss. Only beginners do. Also, what a take profit do? What is a take profit? A take profit is an order that automatically closes your trade once your profit target is reached. Are you getting me? A take profit is an order that automatically closes your trade once your take profit target is reached. So this helps you to secure gain without watching charts all day, and also also helps you in avoiding greed, and also maintain a good risk to reward ratio. Also helps you to stick to your plan. Are you getting me? Step profit bring discipline into your strategy. Are you getting my point right now? The next thing that is that the next thing is stop loss placement strategy. Are you getting me? So in this stop loss placement strategy, number one, below or above support and resistance. Yes. Number two, beyond swing high or lows. Number three is beyond trend line. Number four is outside the consolidation zone. And number five is based on ATR or volatility measurement. So what you need to do is that never place stop loss too tight. You will get stop out early. And also never place it too wide. You risk too much money. So take profit placement strategy is this: next support or resistance zone, previous low or high, Fibonacci level, trend continuation or zone, and also risk to reward targets, whether it is 1:2 or 1:3. The next one is this: use logic, not greed, to decide your take profit. So you need to ask yourself this question: why is stop loss and take profit essential to emotional control? So you need to ask yourself this question: why is take profit and stop loss are essential for emotional control? Number one, trading without stop loss or take profit leads to one, panic. Yes, it leads to panic. Number two, it leads to fear. Number three, it leads to greed. Number four, it leads to impulsive decision. Number five, it leads to revenge trading. Yes. So stop loss and take profit gives you structure, gives you discipline and freedom. So my final thought is this: stop loss protects your capital, while take profit protects your profit. Yes. So use both in every trade and your long-term success increase dramatically. Number three, which is the third topic, risk per trade, which is 1 or 2 to risk to reward ratio. Risk per trade is the 1 or 2% rule that saves traders from blowing their account. The most important rule in forex money management is this 1 or 2% rule, and which the rule says never risk more than 1 to 2% of your total account balance in a single trade. It is simple but powerful, used by professional traders. Why the 1 to 2% risk rule is crucial? You need to ask yourself this question: why is it that the 1% or 2% rule is crucial in trading? Number one, risking a small percentage per trade protects you from losing too much money during bad streaks. Number two, even with several losing trades in a row, your account still stays safe. Example of 2% risk rule. Account size, let me say that you have an account size of $500 and your risk is 2%, and you are which means on a $500 account you are risking $10. This means is that $10 is the maximum you can lose on any trade. If your stop loss is 30 pips, $10 divided by 30, it gives you 0.33 per pip, meaning you are making use of 0.03 lots. So this is how professionals protect themselves. Are you getting my point? So what happens if you risk too much? Here is what happens. Many beginners risk 20% per trade. Some risk 50% per trade. Some even risk as high as 100% per trade. This always leads to account blown out and also the market only need one bad candle to wipe out your whole trading account. So what are the benefits of the 1 to 2 risk percent rule? So you need to ask yourself, what are the benefits of 1 to 2% rule? Number one is that protects your capital. Yes, it protects your capital. Number two is that it reduces your emotional stress. Yes. Number three is that it gives your strategy time to work. Then number four is that it prevents revenge trading. Yes. Then number five is that it creates long-term consistency. Are you getting my point? Yes. Let's continue. Trading becomes easier and more peaceful. So my final thought on this is, if you want to survive and grow in Forex, use the 1 to 2% rule always. It is the safety net that protects you from financial disaster. Number four, full topic content on diversification in Forex trading. So diversification in Forex simply means how smart traders reduce risk and increase stability. Diversification is a major principle in finance, yet many Forex traders ignore it, because diversification simply means not putting all your risk into one place. And in Forex trading, it protects you from unexpected volatility and reduce the chance of major loss. Are you getting my point? So what is diversification in Forex? In Forex, diversification means spreading your trades across one different currency pairs, spreading your trade across different market sessions, also spreading your trade across different setup, and also spreading your trades across different non-correlated pairs. This way, you don't lose big if one currency crashes. So you need to ask yourself, why diversification matters? Because one, it reduces risk. Number two, it smoothens equity growth. Number three, it protects you during bad market condition. Number four, it prevents overexposure. Number five, it helps you to avoid emotional stress. And also, it keeps your portfolio safe and stable. And also, you need to do this. Avoid trading correlated pair together, because so many traders trade correlated pair at the same time. So you need to avoid trading correlated pair together. Why? Because some pair move in the same direction. For example, Euro USD and GBP USD are positive correlated. The USD JPY and CFJPY are the same positive correlated, and also AUD NZD are positive correlated, meaning that they are moving in the same direction. So if one goes against you, the other will likely go against you. Are you getting me? So this, it is like you having a it's like you doubling your risk without knowing. Are you getting my point? So it's like you doubling your risk without even you knowing. So how to diversify correctly? Number one, trade pair from different regions. Number two, avoid correlated markets. Number three, mix trending pair with range ones. Number four, use multiple strategies like trend, breakout, and reversal. Number five, spread position across section. Number six, reduce your lot size when trading many pairs. Your goal is stability, not over trading. Final thought on diversification. Diversification does not mean taking random trades. No, it means spreading smart by risking smartly. So if you want a stable trading journey, a stable trading journey, don't depend on one pair, one setup, or one idea. So let's continue with number five, which is full topic on drawdown and recovery factors. So drawdown and recovery factors, they real indicators of your trading strength. Yes, most traders focus on win rate, profit, and signal, but professionals look at drawdown and recovery factors. This tells you whether your strategy is safe, stable, and suitable. What is drawdown in Forex? Drawdown is the percentage loss your account experiences from a peak to a low point. Yes, of course. It is a percentage of loss your account experience from a peak to a low point. Example, peak. Let me say that your account is $1,000 and your lowest point is $700. You have already lost $300. Drawdown, which is equals to $300 divided by 1,000 by 100, that means 30%. It means that you have already lost 30% of your trading account. A higher drawdown means your strategy is risky and poorly managed. Types of drawdown. There are different types of drawdown. We have equity drawdown, which is floating losses. We have balanced drawdown, which is closed losses. And we have maximum drawdown, which is the highest loss during trading history. Traders must respect drawdown limits to survive in the long term in the market. So every trader, you must respect drawdown limits to survive long term in this business of forex trading. So what is the recovery factor? The recovery factor measures how efficiently you bounce back from losses. So recovery factor equals to net profit plus maximum drawdown. Example, your maximum drawdown is $200 and your net profit is $800. So your recovery factor is $800 divided by $200, which is 4.0. That is a good recovery factor, which is 3 or above. Why drawdown matters? Yes, of course. You need to ask yourself this question: why does drawdown matters in trading? I get my point. Number one is that it shows your risk level. Number two is that it indicates emotional pressure. Number three is that it helps evaluate strategy quality. Number four is that it indicates weakness in money management. Number five is that it protects you from major loss. Then your goal is to keep drawdown low. I get my point. How to reduce drawdown? Number one, reduce lot size. Yes. How to reduce drawdown is very simple. Number one, reduce lot size. Number two, risk 1 to 2 per trade. Number three, use stop loss every time. Number four, avoid correlated pairs. Number five, only take high risk to reward trade. Number six, don't overtrade. And number seven, stick to your plan. So let's continue. Small drawdown means longer term survival. Then my final thought on this is this: drawdown tells you how dangerous your strategy is. Recovery tells you how strong your strategy is. A smart trader monitors both. A smart trader monitors both. So a powerful combination is this: low drawdown plus high recovery factor equals to a safe and profitable system. Then let's talk about capital preservation strategies in forex trading. How smart traders stay alive and profitable. So in forex trading, capital preservation isn't just about concept. It is the foundation of long-term success. No matter how powerful your strategy is, no matter how many wins your trade gets, if you cannot protect your capital, you won't last long in the market. Are you getting my point right now? So professional traders understand this one truth. Your job first is as a trader is not to make money, is to avoid losing money unnecessarily. This is where capital preservation strategies comes in. In this complete section, you will learn the best techniques used by professional traders to protect their trading capitals and their trading accounts and ensure long-term survival in the forex market, and also last long in the business. Ask yourself this question: what is capital preservation in forex trading? Capital preservation simply means protecting your trading funds from unnecessary risks, emotional mistakes, and avoidable losses. It helps you, one, to survive in during losing streaks, two, to trade with confidence, three, to avoid blowing your account, and also four, to maintain discipline, and five, to grow your account slowly and safely. So capital preservation is the opposite of gambling. So it is smart, calculated, and strategic. You need to ask yourself this question: why capital preservation matters more than higher profit? Many beginners chase fast profit. They think growing the account quickly is the key to success. No. But in reality, fast profit often leads to fast losses. High risk creates higher stress and emotional trading. Most blow accounts comes from poor money management and not poor strategies. So these traders who succeed are those who last long enough to let their skill compound. Capital preservation is how they stay long in the game. So top capital preservation strategy used by professional. So let's break it down. The most effective technique to protect your forex capital. Number one is using 1:2% risk rule. The most fundamental way to preserve a capital is to risk only 1 to 2% of your account per trade. Example, if you have a $1,000 account, risking 1% is equals to $10 and risking 2% is equals to $20. The small risk keeps you safe during losing streaks. If you risk 10%, only 10 losses can wipe you out. But if you risk 1 or 2%, you can survive hundreds of trades. Capital preservation begins with small controlled risk. Number two, always use a stop loss. A stop loss protects you from 1. Market volatility, 2. Emotional decision, 3. Sudden reversal, and 4. Unexpected news event. Trading without stop loss is like driving a car with no brakes. It is only a matter of time before disaster. A properly placed stop loss ensures losses stay small and manageable. Number 3, avoiding over leverage. Leverage is a double-edged sword. High leverage amplifies your profit but destroy accounts very fast. Yes, of course. High leverage amplifies your profit but it destroys your account very fast if you don't know. Many beginners blow accounts not because of strategy failure but because they use leverage like 1:500 or 1:1,000. Professional traders use low to moderate leverage on focus on precision and not gambling. Keep leverage under control is one of the most strongest capital preservation skill. Proper position sizing, which is number 4. Proper position sizing ensure that your size matches your account size, matches your risk management, your risk percentage, and your stop loss distance. Are you getting my point? Even a good stop loss becomes useless if your position is too big. Correct loss size is equals to control losses. Oversized lots equals to emotional stress plus big losses. Number 5, avoid revenge trading. Revenge trading happens when a trader tries to get back the lost money quickly. This always leads to overtrading, emotional decision, increased risk and bigger losses, and also account blowout. Walking away after a losses is a capital preservation technique. Self-control protects your money more than any strategy. Number 6 is focus on high quality setup only. So taking random trades destroy capitals. Professionals avoid low quality setup. Are you getting me? They trade only when the conditions are perfect, the trend is clear, and the risk to reward ratio is attractive. Market structure aligns. Patience is a capital preservation skills. You protect your account not by trading low probability setup. Number 7, diversify, don't overload. Trading too many correlated pairs increases risk. Example, Euro USD and GBP USD often move in the same direction. So if one goes against you, the other one will likely follow. So to preserve capital, avoid taking position on correlated pairs. Spread your risk. Trade different instruments or time frames. Diversification reduces unnecessary exposure. Number 8, limit your trading during news events. High impact news such as the NFP, which is non-farm payroll, the CPI, which is the consumer price index, and FOMC, which is fear of missing out, and also interest rate decision, can cause extreme volatility. Even the best strategy becomes unreliable during these moments. Many traders preserve capital by avoiding trade 30 to 60 minutes before major news, using wider stop loss or no trade at all, waiting for the market to stabilize. Capital preservation is about reducing risk. Capital preservation is about reducing unnecessary risk. Are you getting my point right now? So number 9 is daily and weekly loss limits. Professional traders set maximum loss rules such as stop trading after losing 3 trades, stop trading after losing 3% in a day, stop trading after losing 6% in a week. This prevents emotional trading and catastrophic losses. When you hit your limit, stop. Return the next day with a clear mind. Number 10, maintain a trading journal. A journal helps you to identify a bad habit. It helps you to, identify emotional mistakes. A journal helps you to identify overtrading patterns, and also a journal helps you to identify risky behaviors. So understanding your mistake is part of protecting your capital. Awareness that can lead to your improvement in trading the financial market at large. Then how capital preservation leads to a bigger profit. Preserving your capital does not mean avoiding risk. No, it means taking smart and calculated risk. When you protect your capital, you do the following. You protect capital, you protect your account, you survive long enough to learn. Yes. When you protect your account, you survive long enough to learn. When you protect your account, you control your emotion. When you protect your account, you take fewer but better trades. When you protect your account, you allow compounding to work. And when you protect your account, you stay calm and consistent. I get my point. Capital preservation is the seed that grows into long-term profitability. If you don't know, take it from me. Capital preservation is the seed that grows into long-term profitability. So my final thought on this is this. Capital preservation is the real secret of successful forex trader. Many traders focus on making money. The smart ones focus on protecting their money first. This is the mindset of professional. If you master capital preservation strategy, you would do the following. You will reduce unnecessary losses. If you master capital preservation strategy, you will stay calm and confident. If you master capital preservation strategies, you will trade with discipline. If you master capital preservation strategy, you will grow your account naturally. And if you master capital preservation strategies, you will avoid blowing your account. Yes, of course. Always remember, trading is not about how fast you grow your account. It's about how long you can protect it. Master capital preservation and protect your profit and protect your account, and then the profit will follow automatically. Are you getting me? So you need to master capital preservation in your trading. You need to master capital preservation in your trading, because it will help you, to avoid blowing your account. It will help you to stay disciplined, and it will help you, to be confident in the market, and also it help you to reduce unnecessary losses in the market. So capital preservation is very, very, very important for anybody, or for anybody who is a beginner in forex trading. So in this junction, I'll be taking you into my next episode, which is the episode number 9. Episode 9. So you have just finished watching the episode 8. Let's move straight to episode 9. Thank you for watching the episode 8. Let's move right now to episode 9. Thank you. Hello guys. Welcome back to my episode 9. Yes, of course. So welcome back to my episode 9. Let's continue from episode 9. So in this episode 9, we'll be talking about trading psychology. Yes, of course. Trading psychology, the mindset that separates successful traders from everyone else. So in this episode 9, I will tell you everything concerning about trading psychology. I get in my point. I will tell you everything concerning about trading psychology. You need to ask yourself this question: What is trading psychology? It simply mean how you react whenever you are in trading. How you feel, how your emotions react when you are in trading. So it is what encompasses the trading psychology aspect of trading. So let's continue. Trading psychology, the mindset that separates successful traders from everyone else. Are you getting my point right now? So, in forex trading, strategies matters, risk management matters, chart and analysis matters, but the real battlefield is not the chart, but it is the mind. Yes, of course. Most traders lose money not because they do not understand how to analyze the market, no, but because they can't control their emotion whenever they are in trading. Yes, of course. This is why trading psychology is one of the most important pillars of long-term success in trading the forex market. So in this episode of episode 9, you will learn what trading psychology truly means, how emotions affect performance, and the mindset or habit used by consistently profitable traders to make money on a consistent basis doing and when they are applying this trading psychology stuff in their trading career. I get my point. Let's continue. What is trading psychology? If you ask yourself, trading psychology refers to the emotional and mental state that influences your trading decision. Yes, of course. It refers to as the emotional and the mental state that influences your trading decision in the market. Yes. So trading psychology involves your self-discipline, how you discipline yourself whenever you are in the market. It involves patience, how you stay put whenever you are in the market. Trading psychology involves emotional control, how you control yourself whenever you're in the market. Trading psychology involves confidence. Also, trading psychology involves decision making. Also, trading psychology involves stress management. Also, trading psychology involves consistency. And also, trading psychology involves rational thinking. Understand? So, simply put this into perspective that trading psychology determines whether you follow your plan or break your rules. Yes, of course. So, trading psychology determines whether you follow your plan or break your rules. So, why trading psychology matters more than you think? Yes, of course. Why do trading psychology matter more than you think? You can have the best trading strategy in the world, but if fear or greed control your decision, you will definitely lose. Yes, of course. Let me repeat it. You can have the best trading strategy in the world, but if fear or greed control your decision, you will lose. Yes, of course. Common psychological traps include: number one, closing winners too early. Number one. Number two is holding losers too long. Number three is overtrading after a loss. Yes, of course. Number four is fear of missing out, which is FOMO. Number five is impulsive entries. Yes, of course. Number six is revenge trading. Yes, of course. Then number seven is lack of patience. Then number eight is emotional execution. Yes. Let me explain them one after the other. Common psychological trap is closing winners too early. Some traders enter their trade the moment they see winning in their trade, instead of them to hold their trade so that they can make as much money as possible, they close it out due to fear. And also number two, holding losers too long. Some traders, when the trade is going against them, instead of them for them to accept their fate that the trade is going against them, they will keep holding the trade. They will keep holding the losing trade for a long period of time, which in turn blow up the trading account. Number three is overtrading after a loss. Some traders are overmaxing their trading account. They are overtrading because of they have lost the first trade, lost the second trade, and they're trying to make that money as quick as possible back, and they keep losing out. Number four, fear of missing out. Fear of missing out mean when you lose money in the trading, and you see another opportunity. But because of that you have already lost money on the first trade, and you see another opportunity, you'll be experiencing fear for you not to take that trade, the trading opportunity is is likely to play out. But because of fear, you miss out on another opportunity. Then the other one is impulsive entries. Some traders are too quick in entering their trade. That is what it means. Revenge trading. Some traders revenge their trade. The moment they lose their trade, they will like to revenge. The moment they lose their trade, they will like to revenge to trade again. The moment they lose their trade, they will like to revenge, and it is very, very bad. And also, lack of patience. Yes, some traders lack patience. Yes, they lack patience. They lack patience. They don't want to wait for the right time to come for them to execute their trade. Are you getting my point? Yes. The other one is emotional exhaustion. Yes, you are exhausted emotionally. You are down psychologically. So these are the things that that common psychological, common trading psychological mistakes that trap traders. Yes. So a trader worst enemy is not the market. No, it is their own mind. Yes. A trader worst enemy is not the market. No, it is their own mind. Yes. So the three most dangerous emotions in trading are: one, fear. Yes. The three most dangerous emotions in trading. Number one is fear. Yes. Fear shows up in many ways. Number one, fear of entering a trade. That is number one. Number two, fear of losing money. Number three, fear of missing out. And number four, fear of pulling the trigger on a setup. Fear makes you hesitate, close trade early, and avoid good opportunities. Understand? Let's continue. Number two is greed. Greed pushes you to, one, to risk too much in your trading account. Yes. Greed pushes you to two, to over leverage. Then greed pushes you to, to chase trade after profit, because you have made profit, you want to make another profit. Yes, it is part of greed. Number four, greed pushes you to, to remove your stop loss from the initial place you place it. Yes. And also, greed pushes you, to aim for unrealistic targets in the market. It is what the greed does. And every woman be have this part of this greediness in them. That part of greediness in them. It is a human being, because a human being will always want more. We always want more. Are you getting me? So greedy destroy account faster than bad analysis. Yes, of course. You see, greed destroy accounts faster than bad analysis. Just quote me. Number three, let's continue. Number three is hope. Yes, hope. Hope is extremely dangerous in forex. Yes. Hope is extremely dangerous in forex. When losing traders say, "Let me wait a bit, it will come back." This is hope, not analysis. Yes, of course. When a losing trader says, "Let me wait a bit, the market will come back," my brother, this is hope, and this is not analysis. Hope delays decision and magnifies losses. Yes, of course. Hope delays decision and magnifies losses. So you need to be very careful. So now ask yourself this question: how your mind can sabotage your trading? So how can your mind sabotage your trading? It is a very, very interesting question that you need to ask yourself as a trader. How can my mind sabotage my trading? So here are the top psychological traps that can sabotage your trading. Number one is acting without analysis, which is impulsiveness. Yes, of course, impulsiveness. Some traders act without analysis, and it is very, very bad for you to be acting or for you to be placing a trade without analyzing. Most especially those traders who are in signal group, because you do not analyze the pair, because someone else sent you a signal for you to place a trade. You don't know whether that person's signal is accurate or not. You just place trade because you feel that he is accurate, and you not act based on the analysis, but you act without analysis. That is impulsiveness. Number two is overconfidence. After a few wins, traders feel invisible and make sloping mistakes. Yes, of course. If you're on a winning streak, be very, very careful. That is my advice. Because whenever you are in a winning streak, traders feel invincible. They feel that they have arrived, that they can't make mistake again. But I tell you, be very, very careful and make sure that you don't make a sloppy mistake. Because after a few wins, traders feel invincible, and at the same time they begin to make sloppy mistake without them even knowing. Number three, loss aversion. The pain of loss feels stronger than pleasure of winning. Yes, of course. Loss aversion. The pain of loss feels stronger than the pleasure of winning. Number five, confirmation bias. Traders only look for information that agrees with their bias. So traders only look for information that agrees with their bias. Then number six, FOMO, fear of missing out. Are you getting me? Fear of missing out. Jumping into trades late because everyone else is trading. This mental trap forces traders to break their own rule. Yes, of course. This mental trap forces traders to break their own rules and regulation. So, how to build strong trading psychology. This is where successful traders separate themselves from the crowd. I get to my point right now. Let's get it. Let's head over and continue. Have a trading plan, which is number one, and stick to it. It is very, very important. Number two, your plan should include your entry rules. Your plan should include your exit rule. Your plan should include trade stop loss placement. Your plan should include take profit targets. Your plan should include risk per trade, and your plan should include market conditions to avoid. Because successful traders follow their plan with discipline. Number two, accept that losses are part of the game. Yes, of course. Accept that losses are part of trading. Even the best traders in the world lose trades. Losing doesn't make you a bad trader. Not following your rules make you a bad trader. Yes, of course. Losing doesn't make you a bad trader. No. Not following your rules does make you a bad trader. Yes, of course. Number three, practice patience. Patience is one of the strongest skill in trading. Yes, of course. Wait for higher quality setup. Be patient. Don't force trades. Be patient. Don't chase the market. Be patient. It is very, very important. Practice patience, because the patient dog eat the fattest bull. Meaning, trading less often usually leads to better results. If you trade less, you have more better results. Number four, using a trading journal. Yes, of course. Document your trade, emotions, mistake, and improvement. So you need to document your trades, your emotions, your mistake, and improvement. The other one is a journal. A journal exposes psychological weakness and helps you eliminate them. So five, focus on process, not profit. Or focus on the process, not profit. Obsessing obsessing over profit leads to stress and emotional decision. So many people are obsessed with profit. Understand? So many traders are obsessed with over profit, and it leads them to stress and emotional decision. So you need to focus on executing correctly, managing risk very, very effectively, and also follow your rules and regulations. Very, 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 very important. Are you getting me? Because profit is result and not the goal. The goal is to be a well-skilled trader who understand the market. Then profit is the result, not the goal. Number six, master emotional control. Yes, of course. You must learn to detach emotional from each trade. Yes, of course. You must learn to detach emotional from each trade. The market does not care. Yes, of course. The market does not care about your feelings. The market does not care about your bills. The market does not care about your problems. The market does not care about your hopes. So detach, observe, and execute logically. Yes, of course. Detach, observe, and execute logically. Number 7, take break after losses. A loss creates emotional pressure. Your brain wants to earn it back. So take a break after a loss. It will help you a lot. Walking away for 10 minutes or 30 minutes protects your capital and mind. Yes, of course. Walking away for 10 minutes, 30 minutes protects your capital and mind. The threat of a mentally strong trader. So right now, what are the threats of a mentally strong trader? Yes, of course. So the threats of a mentally strong trader, here are the following. A mentally strong trader is highly disciplined. Yes, of course. I cannot overemphasize this. A mentally strong trader is highly disciplined. You must be disciplined every time whenever you're in the market. Number 1, a mentally strong trader trusts their strategy. Yes, you need to trust your system. You need to trust your strategy. Number 3, a mentally strong trader controls their emotion. Yes, of course. Number 4, a mentally strong trader uses consistent risk management. Yes. A mentally strong trader has patience. A mentally strong trader avoids unnecessary trades. A mentally strong trader accepts losses with calmness. A mentally strong trader treats trading like a business. Yes, of course. Yes, of course. So many traders treat trading as a joke, but a mentally strong trader treats it as a business. A mentally strong trader learns continuously. Yes, of course. Because in trading, you keep on learning. You keep on learning. Because if you're not informed, you are deformed. A mentally strong trader, the last but not the least, improves through reflection. So of course, as a trader, after trading the day or during the week, you reflect on your trading. Are you getting my points? So these are qualities that matter far more than predicting the market. So of course, so these are the qualities that matter matter far more than predicting the market. Are you getting my point? So developing the mindset of a professional trader. Yes. So I'm going to be telling you the proven ways professionals maintain strong trading psychology. Yes, of course. I'm going to be telling you the proven ways professionals maintain strong trading psychology. Number 1 is meditation and mindfulness. Yes, of course. It helps reduce anxiety and improves focus. Number 2, backtesting. Backtesting builds confidence in your strategy. Yes, of course. Yes, backtesting building confidence in your strategy. This is what backtesting does. Then trading only during your best hours. Avoid fatigue and impulsive decision. Number 4, maintaining a healthy lifestyle. Good sleep, hydration, which is drinking a lot of water, and exercise improve your mental clarity. Yes, of course. Good sleep, hydration, and exercise improve your mental clarity. The next one, focusing on long-term results. Think in terms of 100 trades and not one trade. Are you getting my point? Think in terms of 100 trades and not one trade. The final truth is this. Trading is 80% psychology and 20% strategy. Yes, take it from me. Take it from the Financial Academy YouTube channel. Trading is 80% psychology and 20% strategy. While strategy determines your potential, mindset determines your results. Strong psychology allows you to do the following. Follow your risk, follow your plan consistently. Yes, of course. Strong trading psychology allows you to follow your plan consistently. Strong psychology in trading allows you to manage your risk properly. Strong psychology in trading allows you to stay calm under pressure. Strong psychology in trading allows you and makes you to avoid emotional mistakes. Strong psychology in trading allows you to trade with clarity and confidence. And also, strong psychology allows you to grow your account steadily and consistently. So if you master your mind, you master your trading. Yes, of course. If you can master your mind, then you have master trading. Emotions in trading. Yes, of course. So emotions in trading. Let's head over to the next step, which is fear, greed, hope, and regret, which is the hidden forces controlling every trader. Yes, including me that is teaching you this thing. These are the hidden forces controlling every trader. But if you can be able to avoid these things, my brother, we'll be making money steady in the market. Most traders believe that strategies, indicators, or market analysis determine their results. But the truth is this: your emotions control your trade far more than your strategy does. Yes, of course. Your emotions as a trader control your trade far more than your strategy does. The forex market is a psychological battlefield. Yes, of course. Now, if you don't know, the forex market is a psychological battlefield. Every buy or sell button you press is influenced by four powerful emotions. Is influenced by fear, is influenced by greed, is influenced by hope, and is influenced by regret. If you don't learn how to control this emotion, they will control your trading, often leading to blown accounts, missed opportunity, and endless frustration. So in this section, you will learn how each emotion affects your decision and how to master them like a professional trader. Number one, let's begin with the fear. Fear, the emotion that paralyzes traders. Fear is the strongest emotion in trading. It shows up in different ways. Number one, types of fear in trading. Number one is fear of losing money. Yes. Number two, fear of entering a trade after you have losing your trade before. Number three, fear of missing out an opportunity, fear of pulling trigger, and also fear after a losing streak. So fear makes traders. What does fear make traders? One, it makes them to close a winning trade too early. Yes, of course. Fear makes traders to close a winning trade too early. It makes them to avoid good setups. And also it makes them to enter late because they hesitate. And also it makes them, to exit trade prematurely. So change their strategy under pressure. So fear makes some traders to change their strategy under pressure. How to overcome fear as a trader? Number one, always trade with a small fixed risk per trade, whether it is 1% or 2%. Number two, always use a stop loss. Yes, very, very important. Number three, trust your tested strategy, which is number three. Number four, accept that losses are part of the game. Yes. Number five, focus on long-term results, not single trades. Yes, of course. A trader who controls fear becomes more confident, calm, and consistent. Yes, of course. Number two, greed. Greed, the emotion that destroys accounts quickly. If fear keeps you out of trade, then greed traps you inside them. Yes, of course. If fear keeps you out of trade, greed traps you inside them. So greed makes traders do the following: increase lot size irrationally. Greed makes traders remove stop loss. Greed makes traders chase every market movement. Greed makes traders take unnecessary trades. Greed makes traders hold winning trade too long. Greed makes traders expect one more big move. Greed convinces you that the market will follow your wishes, but the market respects no one. Yes, of course. Greed will convince you that the market will follow your wishes, but in reality, the market respects no one. How to control greed in the market? Number one, use a predefined take profit level. Yes, of course. Use a predefined take profit level. Number two, stick to your position sizing rules. Yes, of course. Number three, never increase risk without planning. Yes, of course. Number four, trade only your setup, not every chart movement. Yes, of course. Trade only the setup that is very, very have high accuracy and not every chart movement. Yes, of course. Number 5, focus on discipline, not fast profit. Yes, of course. Focus on discipline and not fast profit. Remember, slow, stable growth beats random big win every time. Slow, stable growth beats random big win every time. Are you getting me? Number 3, hope. The emotion that makes traders hold losing trade. Yes, of course. Hope is the emotion that makes traders hold losing trades. Hope can be dangerous in Forex. It appears when you are in a losing trade and you keep telling yourself it will turn around soon. Just a little more time. I don't want to lose. I don't want to close in loss. Yes, of course. So, what does hope does you in Forex trading? It makes you that it is not telling you that whenever you're in trade, it will tell you it will turn around very soon, and it will be doing you like just a little more time. The market will go in my favor, and more also. I don't want to close in loss, stuff like that. But hope leads you to do the following. Hope leads you to ignore the stop loss. Hope leads you to adding to a losing position. Hope leads you to turning small losses into a huge losses. And also hope leads you to borrowing account because you believe too much. Hope is not a strategy. Price action is. Are you getting me? Let me repeat it again. Hope is not a strategy. Price action is. Let's continue. How to eliminate hope-based trading. How to eliminate hope-based trading. Number 1, accept loss quickly, which is very, very important. Never move your stop loss further away, which is number 2. Follow market structure, not emotions, which is number 3. And understand that not every trade will be profitable, which is number 4. Because a professional trader follow the rules, not wishes. Number 4, regret, the emotion that causes revenge trading. Are you getting me now? Regret happen after miss a great trade, close trade too early, enter too late, and also break your rules, lose money due to emotional decisions. Regret often turn into 1, revenge trading, trying to get losses back fast. Over trading, jumping into random trades, and lose of discipline. Are you getting me? So this emotional spirit destroy account faster than bad market condition. How to reduce regret in the market as a trader? Number 1, accept that the market gives you endless opportunity. Yes, of course. Review your journal instead of reacting emotionally. Yes, of course. Stick to your trading plan. Very, very important. And also learn from mistake instead of chasing the next trade. Regret is normal, but it doesn't influence your next decision. How these 4 emotions interact? You'll be asking yourself, how does these 4 emotions interact? These emotions often change together. Fear stops you from entering the trade. Greed pushes you to over-risk. Hopes keeps you in a losing trade. And regret leads you to revenge trading. Are you getting my point? So this emotional cycle keeps traders stuck for years. The winning traders break the cycle by mastering emotion discipline. So you need to ask yourself how to gain emotional control in trading. It's very, very important. How to gain emotional control in trading. Number 1, here are powerful techniques to control your emotion whenever you're trading. Number 1 is 1, have a written trading plan. Yes, of course. Yes, of course. Have a written trading plan. A plan eliminates impulsive decision. That is 1. Number 2, use fixed risk per trade. Yes, of course. Use fixed risk per trade. Small risk reduces emotional pressure. Number 3, follow your strategy strictly. When you trust your system, emotions weakens. Yes, of course. Keep a trading journal. It helps you to recognize emotional patterns. Yes, of course. Number 5, avoid trading when emotional. Stress, anger, tiredness, or excitement leads to mistakes. Number 6, take break after losses. This prevents revenge trading. Yes, of course. Number 7, think long term. One trade doesn't define you, the series does. Yes, of course. The mindset of a professional trader. So in this section, I'm going to be telling you the mindset of a professional trader. What are the kind of mindset that you need to have for you to be a professional trader? What are the qualities that you need to have for you to be a professional trader? A professional trader does the following. Number 1, a professional trader accepts losses without emotional pain. Yes. Number 2, a professional trader trades only when the setup is valid. Number 3, a professional trader never risks too much. Number 4, a professional trader never chases the market. Number 5, a professional trader keeps calm during volatility. Number 6, a professional trader follows their rules without emotions. Yes, trading becomes easier when you stop trying to control the market and start controlling yourself. Yes, of course. Let me repeat it again. Trading becomes easier when you stop controlling the market and start controlling yourself. My final thought is this: master your emotion, master your trading. Yes. So if you can be able to master your emotion, you can master your trading. Fear, greed, hope, and regret are natural human emotion, but they are dangerous when mixed with money. Are you getting me? So the goal is not to eliminate emotion, no. The goal is to recognize them, understand them, and prevent them from controlling your decision. So if you can master your emotion, your result will improve, your decision will become clearer, your consistency will increase, and your confidence will grow. In trading, your mindset is your greatest weapon. Use it wisely. Are you getting me? In trading, your mindset is your greatest weapon. Use it wisely. So let's talk about discipline and patience in forex trading, the unsung heroes of success. So let's continue. When it comes to forex trading, most beginners focus on charts, indicators, and strategies. Yet the true differentiator between consistent winners and losers isn't the tool you use, it's your mindset. The two traits define profitable traders. The two traits define profitable traders are discipline and patience. Without them, even the best strategy can fail, and even the most promising setup can become a disaster. So in this section, we will explore why discipline and patience matter and how they impact your trading performance, and practically ways to develop them for a long-term success. So why discipline matters in trading? You need to ask yourself this question: why does discipline matters in trading? It's a very, very important question for you to ask yourself. Discipline is the ability to stick to your trading plan, follow your rules, and avoid impulsive decision. Are you getting me? In forex, discipline protects you from 1, chasing loss. Discipline protects you from over trading. Discipline protects you from ignoring stop loss and take profit level. And also discipline protects you from making emotional decision under market pressure. So now, what are the costs of indiscipline? What are the things that you're going to encounter when you decide to be indisciplined? Imagine entering a trade without a stop loss because you feel the market will turn in your favor. One sudden spike can wipe out your account. Indiscipline doesn't just cost money, it costs confidence and your trading career. Patience, waiting for the right opportunity. Patience is equally critical because it is the ability to wait for high quality trade setup rather than forcing trade out of boredom or fear of missing out. FOMO. Many beginners make the mistake of trading and the market move, hoping to cash profit. The result is multiple small losses that add up to big frustration. A patient trader waits for the following. 1. Wait for a clear trend to happen in the market. A patient trader confirms support and resistance level. A patient trader use proper risk management setup, and also a patient trader use market condition that matches their strategy. Remember, you don't need to be in every trade to be profitable. Waiting for the right opportunity is a strength and not a weakness. How discipline and patience work together? So you need to ask yourself, how does discipline and patience work together? Let's continue. Discipline without patience can lead to rigidity. Traders follow rules but force trade that doesn't meet their criteria. So of course, traders follows their rules. Well, that is very important. But they force trade that doesn't meet their criteria. Patience without discipline can lead to inaction. Traders wait but fail to execute when the perfect setup appears. Are you getting me? Traders wait but fails to execute when the perfect setup appears. But when combined together, what will happen? You follow your trading plan strictly. You only enter trade with favorable condition. You respect your risk limit and money management rules, and you reduce emotional trading decision. Are you getting me? So the result is consistency, steady growth, and calmer mindset. Practical tips to build discipline. One is this: create a trading plan. Define your entry, your exit, stop loss, and take profit rules. Very, very important. Number two, include maximum daily losses and number of trades. Number three, stick to your plan. Avoid deviation unless there is a valid reason. Treat your loss as non-negotiable. Number three, use journal. Record every trade, reason for entry, and emotional state. Review mistakes to improve your self-discipline. Number four, set alerts and limits. Use technology to enforce your rules automatically. Are you getting me? Let's continue. Practical tips to build patience. Number one, wait for the setup. Only trade when your system or strategy signals a clear opportunity. Are you getting me? Yes, of course. Number two, avoid market noise. Yes, of course. Avoid market noise. Ignore minor price fluctuation. Focus on meaningful moves. Number three, focus on quality and not quantity. Fewer trades with high probability setup are better than many trades with low probability setup. Yes, of course. Number four, mindful trading. Practice meditation or deep breathing to reduce impulsive action. Yes, of course. Practice meditation or deep breathing to reduce impulsive action. Then, the psychological edge of discipline and patience. Yes, of course. What are the psychological edge of discipline and patience? Let's continue. Traders who master discipline and patience gain a psychological edge. Number one, reduce stress and emotional swing. Increase confidence in their strategy. Ability to handle losses without a revenge trading. And also consistent profit over time. Understand this, that market will always fluctuate. Those who can control themselves, not the market, always win in the long run. Are you getting me? Yes, of course. In conclusion, discipline and patience are the cornerstone of successful trading. Without them, even the best strategy fails, and even the most promising traders struggle. Are you getting my point? So by sticking to your trading plan, by managing your risk carefully, by waiting for high quality trade setup, and avoiding impulsive decision, you build consistency, control your emotion, and protect your trading capital. Remember, trading is not about speed or excitement. It is about smart, calculated decision and waiting for the perfect opportunities. Master discipline and patience, and the profit will follow naturally. Are you getting my point? Let's continue. Trading plan development. Your roadmap to consistent forex success. So let's talk about the trading plan development. Are you getting me? In forex trading, many beginners dive into the market chasing profits, hoping to figure out along the way. But the harsh reality is that without trading plan, this approach often leads to losses, emotional decision, and frustration. Are you getting my point? So a trading plan is not optional. It is the foundation of every successful trader. Think of it as your personal roadmap. It guides your action, control your risk, and ensures consistency in an unpredictable market. So in this section, you will explore the importance of trading plan, its key components, and how to develop one that works for you. So ask yourself this question: why do I need a trading plan? Are you getting me? Why do you need a trading plan? Because a trading plan brings structure to the chaos of forex market. So it helps you to define your goal clearly. A trading plan helps you to manage your risk effectively. A trading plan helps you make objective trading decision, avoid emotional mistake like revenge trading or fear of missing out FOMO, and also evaluate and improve your performance over time. Understand? Without a plan, without a plan, trading is essentially gambling. But with a plan, it becomes discipline, strategic activity. What are the key components of a successful trading plan? So it's more of like you want to start a business, but you don't have a plan of for that business. What will happen? The business will fail. So if you are doing a business and you don't have a concrete plan for that business is more likely to fail. So as it is in trading. So you need to have a plan as a trader. You need to have a rule-based system. You need to have a systematic approach to trading. That is where trading plan comes in place. So you need to have a trading plan in trading so that you can be successful in trading in the long time and in the long run. I get my point right now. Let's continue. Key component of a successful trading plan. Let's continue. A robust trading plan should include several critical elements. Yes, of course. A robust trading plan should include several critical elements. Number one, trading goals. Define what you want to achieve. Monthly or annual profit target. That is number one. Risk adjusted returns. Then personal growth and learning objective. Clear goals provide direction and helps you to measure progress realistically. That is number one. Number two is trading strategy. Your strategy defines when and how you enter and exit trade. I get my point. Your strategy defines when and how you enter and exit trade. So technical analysis, indicators, sharp pattern or support and resistance. Fundamental analysis, which are economic news, central bank decision, and global events. Combination using both technical and fundamental factors. So a clearly defined strategy ensures that every trade you take has a valid reason for trading for taking that trade. So a clear defined strategy ensures that every trade you take has a valid reason for that. Let's continue. Number three, risk management rules. It's very important. Risk management rule. This is where so many traders lose their money. Risk management rule. But make sure you are listening to this thing, because I have taken my time to break this down for you. Because not everybody will break this. Because not everybody will break it down for you like this. Risk management protects your capital and ensure longevity in the market. Understand? Risk per trade commonly 1 to 2% of your account. Number one. Use of stop loss and take profit orders. Number two. maximum daily or weekly loss limit. Number 3, position sizing guideline. Are you getting me? So a strong risk management framework prevents small mistake from becoming account destroying losses. Are you getting my point right now? It is very, very important. Number 4, trade management. Your plan should detail how you manage after entry. Yes, of course. Your plan should detail how you manage trade after entry. Yes, of course. Moving stop loss to break even. That is number 1. Scaling out of position. That is number 2. And adjusting trade based on market condition. So trade management reduces emotional decision during live market fluctuation. Number 5, trading schedule or trading schedule. Forex operates 24 hours and 5 days in a week, but you don't need a trade. You don't need to trade consistently. Are you getting my point? Yes, of course. You don't need to trade consistently every day from Monday to Friday. No, you need to have a defined preferred trading hours. You need to have a currency pair to focus on, and also frequency of trades per day or week. Are you getting my point right now? Also, to ensure a schedule used consistently to prevent overtrading. So a schedule ensures consistency and also prevents overtrading. Number 6, performance review and improvement. A trading plan isn't static, it evolves as you grow. Include keeping a traditional journaling, record reason for each trade, analyzing wins and losses, and also adjusting strategies based on performance. So regularly review improve decision making and strengthen discipline. Are you getting me? So steps to develop your trading plan. Number 1, follow these steps to create a practical trading plan. Number 1, assess yourself. Understand your risk tolerance, personality, and trading style. So for you to create a practical trading plan, because now this is the step to develop your trading plan, you need to understand yourself, as a person. You need to understand your risk tolerance as a person. You need to understand the amount of money that you can take in, that if you lost it, that it won't touch you psychologically. And also you need to understand your trading style, what suits you. Are you getting my point? So let's continue. Number 2, define clear goals. Set realistic profit targets and learning objective. So you need to set a realistic profit target and learning objective in the market. It is very, very important. Are you getting me? It is very, very important. Yes, of course. Number 3, choose your strategy. Yes, of course. You need to choose your strategy. It's very, very important. If you don't have a strategy, choose your strategy. Identify which technical or fundamental tools you will rely on. So identify which technical tools or fundamental tools will you rely on. Are you getting me? Let's continue. Number 4, set risk management rule. Yes, of course. Set risk management rule is very, very, very important. Set risk management rule. I can't overemphasize this, guys. Determine stop loss, take profit, and position sizing. It is very, very important. Number 9, create trade management guideline. Yes, create trade management guideline. Decide how you will handle your trade after entry. Yes, of course. Decide how you will handle your trade after what? Entry. Number 6, establish a trading routine. Yes, of course. Define your schedule and currency pairs. It is very, very important. You need to define your schedule and the currency pair that you will be trading. Are you getting me? Number 7, document everything. So you need to write your plan clearly and follow it like a rule book. Are you getting me? So you need to, write your plan clearly and follow it like a rule book. Yes, of course. The next one is to review and refine. Yes, of course. You need to review and refine. Are you getting me? By this, I mean track results, learn from mistake, and make adjustments. Yes, of course. You need to track your results, learn from mistakes, and have this adjustment in your trading when you make the mistake. Then, what are common mistakes to avoid in trading plan development? It's a very, very, very important question. What are the common mistakes to avoid in trading during this time period? One, the common mistakes to avoid when writing a trading plan development is being too voyage and unrealistic. Yes, of course, being too vague and unrealistic as a trader. Number two, ignoring risk management rules. Yes, of course, which is very, very important. When writing a trading plan, don't you ever ignore the risk management rule. No. Number three, changing strategies impulsively. When writing a trading plan, don't change strategies impulsively. Number four, neglecting performance review. And number five, trading outside defined schedule or currency pairs. Avoiding these mistakes ensures your plan remains a powerful tool rather than a guideline you ignore. Now, let's talk about the benefits of a solid trading plan, because there are so many benefits that comes when you have a solid trading plan and you follow it religiously. Traders who stick to their plan gain one, consistency. By this I mean following rules removes guesswork. Yes, of course. Number two, confidence. Clear guideline reduces fear and hesitation. Number three, discipline. It prevents emotional trading decision. Number four, profitability. It helps you focus on high probability setup. Number five, longevity. It protects your account during losses, because a plan turns forex trading from a risky game into a structured and professional pursuit. Yes, of course. A plan turns forex trading from a risky game into a structured and a professional pursuit. So, in conclusion of this, developing a trading plan is the single most important step to becoming a successful forex trader. It defines your goal, strategies, risk management rules, and review processes, giving you clarity, discipline, and confidence in every trade. Are you getting me? Remember, trading without a plan is gambling, but trading with a plan is a business. I'll repeat it again. Trading without a plan is gambling, and trading with a plan is a business. Start small, document your rules, and stick to them consistently. It is very, very important. Start small, document your rules, and stick to them consistently. Over time, your trading plan will become your most valuable asset in the journey of your financial success. Are you getting me? So let's continue. Let's continue to handling losses in forex trading. How to stay profitable and emotionally strong. Are you getting me? One of the harshest reality of forex trading is this: losses are inevitable. Yes, of course. Please, in forex trading, you can't do away with losses, because losses are inevitable in forex trading. You must lose in one way or another. Are you getting me? Even the most experienced traders face losses, face losing trades. Yes. But the difference between successful traders and those who fail is that how they handle their losses. Yes, of course. So if you want to trade consistently and grow your account over time, learning to manage losses both financially and emotionally is not optional. Are you getting me? So in this section, we will explore why losses happen, the psychology behind them, and practical strategies to handle them effectively. So ask yourself this question: why losses are part of trading? Forex is a volatile market. No strategy, no strategy, no matter how perfect, guarantee a win every time. Losses occur due to one, market unpredictability, economic event or new surprises, mistimed entries or exits, and also emotional decisions like chasing trade. The key is to expect losses, accept them, and plan for them. Yes, of course. The emotional impact of losing trades. Many traders struggle not because of their strategy, but because of the emotion losses can trigger. Why? One, fear. worrying about losing more money. Regret, thinking I should have exited early. 3. Anger, blaming the market or yourself. And 4. Impatience, trying to recover losses immediately. These emotions often lead to revenge trading, taking impulsive trade to get back what was lost, which usually results in even bigger losses. Financial strategy to handle losses. Number 1 is this. Use the 1 to 2% rule. Never risk more than 1 to 2% of your account on a single trade. This ensures that a single loss won't destroy your account. Even a string of losses becomes manageable. Number 2, set stop loss orders. A stop loss automatically exits your trade at a predefined level. It caps your losses and prevents emotion from interfering with your decision making. Are you getting me? Number 3, position sizing. Adjust your trade size based on your account balance and risk tolerance. Proper sizing helps you to survive losing streaks without panicking. Are you getting me? Number 4, diversify trades. Avoid putting all your capital into one trade or one currency pair. Diversification spreads the risk and reduces the impact of any single loss. As of course. Now ask yourself, what is the psychological strategies to handle losses? Number 1, accept losses are part of trading. Yes, of course. Accept that losses are part of trading because every trader loses at some point. Accepting losses mentally makes it easier to stick to your plan and avoid emotional overreactions. Are you getting me? Number 2, keep a trading journal. Document every trade, including losing ones. Write them down because the reason for the trade. Write them down by telling yourself, what is the reason for the trade? How is your emotion during this trade? And lesson you have learned. Reviewing your journal helps you to understand mistakes and avoid repeating them. Are you getting me? Number 3, avoid revenge trading. After a loss, taking a break, don't jump into another trade without being out of anger or impatience. By this I mean, after taking a loss, take a break. Don't jump into another trade out of anger or impatience. Give yourself time to reset emotionally. Number 4, focus on the long term. Yes, of course. Trading is a marathon and not a sprint. One loss or even several doesn't define your success. Stay patient and disciplined and look at your overall performance over weeks and months. Are you getting me? Turning losses into learning opportunity. Listen to me. Every loss carries a lesson. Do you follow your trading plan? Was your stop loss too tight or too wide? Do you enter a trade too early or too late? Were emotion influencing your decision? By analyzing losses objectively, you improve your strategy and strengthen discipline, turning failures into growth. Are you getting me? So, the role of discipline in handling losses. 1. Discipline is crucial for managing losses. It means that following your risk management rules strictly, exiting trade according to your plan, avoiding impulsive decisions, and also maintaining emotional control. Are you getting me? Traders can master discipline, recover faster, and maintain consistent profitability even during losing streaks. Are you getting me? So in conclusion of this, losses are inevitable in forex trading, but they don't have to be devastating. The key is to manage them wisely, both financially and psychologically. So how to handle losses effectively? Number 1, risk only 1 to 2% per trade. Very, very important. Number 2, use stop loss and proper position sizing. Very, very important. Number 3, keep a trading journal. Very, very important. Number 4, avoid revenge trading. Let me repeat it again. Avoid revenge trading, very, very important. Number 5, learn from every losses, very, very important. Number 6, stay disciplined and focus on the long term, very, very important. Remember, trading success isn't about avoiding losses. It is about how you handle them. Mastering loss management is what separates consistent, profitable traders from the rest. Understand? Are you getting me? Let's continue. Building consistency in forex trading, the key to long-term success. In forex trading, talent and strategy alone doesn't guarantee success. One of the most overlooked but crucial traits of profitable trader is consistency. Are you getting me? Yes, consistency. Consistency is what separates traders who makes occasional profit from those who achieve steady growth over months and years. Without it, even the best strategies fail, and emotion like fear, greed, and impatience takes over. In this section, we will explore why consistency matters, what challenges what challenges traders face, and practical steps to build consistent trading habits that deliver long-term results. Why consistency is crucial in forex trading. Consistency in trading means applying your strategy, risk management, and trading plan reliable over time, because the benefits include predictable performance. You know what to expect from your trading account, which is number 1. Emotional stability. It reduces impulsiveness and emotional decision. Number 3, long-term profitability. Small, steady gain accumulate over time. Then number 4, better decision making. Consistency allows you to analyze and improve your trade systematically. Are you getting my point? So without consistency, even profitable trades are overshadowed by erratic losses. Are you getting me? So challenges traders face in maintaining consistency. Number 1 is emotional trading. Fear and greed cause traders to deviate from their plan. Number 2, overtrading. Trading too frequently to cash profit leads to mistakes. Number 3, ignoring risk management. Skipping stop loss or risking too much per trade disrupts your consistent growth. Number 4, changing strategies frequently. Consistently switching strategies prevents mastery. Number 5, impatience. Wanting instant results leads to poor trade selection and impulsive action. So understanding this pitfall is the first step towards building consistency. Are you getting my point? So practical steps to build consistency. Number 1, follow a trading plan. Are you getting me? A well-defined trading plan is your roadmap, and it should include entry and exit criteria, risk management rules, preferred trading hours and pairs, and also maximum daily loss limit. So following your plan consistently reduces mistake caused by emotions. Number 2, use proper risk management. Risk management ensures that no single trade can destroy your account. Here are the key rules included: risking 1 to 2% of your account per trade, setting stop loss and take profit levels, and also using proper position sizing. Consistently managing risk keeps your account steady even during losing streaks. Are you getting me? Number 3, trade only high quality setup. Avoid temptation to trade everything. Focus on trade that meets your criteria strategy wisely. Quality over quantity. Ensure that your results are predictable and replicable. Number 4, keep a trading journal. Record every step, every trade, including entry and exit point, trade rationally, emotions experienced, and lesson learned. Reviewing your journal regularly helps identify patterns, mistakes, and area of improvement, strengthening consistency. Are you getting me? Number 5, develop emotional control. Consistent traders manage emotion effectively. These techniques include meditation or mindfulness exercise, avoiding leverage trading, taking breaks after losses, and focusing on processes, not the outcome. Because emotional control prevents impulsive decision that disrupts consistent results. Number 6, set realistic goal. Avoid chasing unrealistic profits. Set small, achievable targets and measure success by consistencies, not by individual win. Over time, this small, consistent gain compound into significant profit. Number 7, stick to a routine. Create a disciplined trading routine. Review chart before trading session. Analyze news and economic events. Execute trade according to your plan. Reflect on results at the end of the day. A routine enforces habit and consistency. Are you getting me? Let's continue. Then the long-term benefit of consistency. Traders who build consistency experiences steady account growth instead of volatile spikes. Confidence in their strategy, reduced emotional stress and ability to survive losing streaks, because consistency doesn't guarantee profit overnight, but it ensures survival and steady growth, which is the ultimate goal in forex trading. In conclusion of this section, building consistency in forex trading is not about winning every time or every trade. It is about following your plan, managing risk, controlling emotion, and taking high quality trade reliably. Understand? So focus on sticking to your trading plan, number 1. Focus on number 2, managing your risk properly. Focus on number 3, trading selectively with discipline. Focus on number 4, maintaining a journal and reviewing your performance. And number 5, developing patience and emotional control. Are you getting me? Success in forex is a marathon and not a sprint. Consistency is the engine that drives long-term profitability. Master it and the results will follow you. Are you getting me? So let's head over to the next section, which is avoiding overtrading in forex trading, protecting your account and sanity. One of the biggest pitfalls for beginner and even intermediate forex traders is overtrading. It is easy to fall into the trap of chasing profits, taking every opportunity, and trading impulsively. While trading frequently may feel productive, it may often lead to burnt accounts, emotional stress, and inconsistent results. So in this section, we will explore what overtrading is, why it's dangerous, and practical steps and strategies to avoid this, because helping you trade smarter and not harder. So ask your question. What is overtrading? Overtrading occurs when a trader executes too many trades in a short period, enters low quality setup that doesn't meet their strategy criteria, also trade out of emotion, boredom, or the desire to make back losses, and also risk too much on each trade. So it is essentially trading without discipline or patience, which is a fast track to account blowout. Why overtrading is dangerous? Because 1, emotional drain. Constant trading amplifies stress, fear, and greed. Emotional trading leads to poor decision. Number 2, increased transaction cost. More trades, more spread and commission, which can slowly eat away all your profit. High risk exposure. Trading frequently increases the chance of you taking losses that exceed your risk tolerance. Are you getting me? Number 4, decrease focus and quality. When trading too much, it is possible to analyze every setup carefully. Mistakes happen even with a strong strategy. Number 5, revenge trading trap. After losses, overtrading often leads to impulsive attempts to recover, which usually causes even bigger losses. Sign you might be overtrading. Yes. So these are the signs that you might be overtrading. Number 1, trading outside your usual time frame or strategy rules. Number 2, entering trade impulsively without proper analysis. Number 3, increasing position size after a loss. Number 4, feeling anxious, restless, or pressured to trade. Number 5, ignoring risk management rule. So if any of these sound familiar, it is time to step back and reassess your trading habits. So how to avoid overtrading? Number 1, follow a strict trading rule. A well-defined trading plan helps you to know when to trade and when to stay out of the market. Stick to it religiously. Only take trade that meets your criteria. Number 2, limit the number of trades per day. Set a daily or weekly trade limit. For example, maximum of 2 to 3 trades per day, and maximum of 10 trades per week. This prevents impulsive decision and keep your focus on quality setup. Number 3, risk management rules. Always, always risk only 1 to 2% of your account per trade. Know your maximum loss per trade and per day helps avoid chasing losses. Understand? Number 4, take break between trades. After a loss or winning streaks, step away from the screen. Short breaks help reset emotion and improve decision making. Number 5, focus on high quality setup. Avoid trading just because the market is moving. Wait for trades that meet your strategy, rules, risk to reward ratio, and technical or fundamental analysis. Number 6, keep trading journal. Document every trade, including the reason for entry, exit, and your emotional state. Review your journal to identify your pattern of overtrading. Number 7, avoid revenge trading. Accept losses calmly. Trading impulsively to recover losses almost fire back. Understand? So accept losses calmly. Trading impulsively to recover losses almost always backfires. Now, let me tell you the psychological tips to prevent overtrading. Number 1, practice patience. Wait for the best setup instead of forcing trade. Number 2, staying emotionally natural. Avoid trading when angry, frustrated, or overly excited. Number 3, visualize discipline. Remind yourself that missing a trade is better than losing money. Number 4 is set goal for process, not for profit. Focus on following rules and maintaining consistency rather than chasing immediate gain. Then the benefit of avoiding overtrading. Number 1, traders who avoid overtrading experience consistent account growth. Also, reduce emotional stress and also better focus on high probability trades. Improve risk management, adherence, long-term profitability, and sustainability. Remember, forex trading is a marathon and not a sprint. Less can be more when it comes to trades. In conclusion, overtrading is the quickest way to destroy your account, increase stress, and lose discipline. Avoiding it requires patience, strict adherence to your trading plan, and emotional control. So to prevent overtrading, you need to do what? To stick to your trading plan. You need to limit the number of trades per day or week. You need to trade only high quality trade setup. You need to use proper risk management. You need to take break and avoid revenge trading. And at the same time, you need to track trades and emotion in your journal. By focusing on quality over quantity, you protect your capital, reduce emotional strain, and build long-term consistency. The true hallmark of successful trader is this: you need to have quality over quantity. Are you getting me? So let's continue with the next section, which is mindset for long-term success in trading. Think like a professional. Forex trading is not just about strategies, indicators, or market knowledge. While these tools are important, they are secondary to one critical factor, which is the mindset. The traders who succeed over the long term are those who think differently and act consistently and manage their emotion effectively. So without the right mindset, even the best strategy will fail. So in this section, we will explore what it means to have the right mindset for forex trading, why it matters, and practical steps to develop it for a long-term success. So why mindset matters than strategy? Here is the reason. Many traders make the mistake of believing that profitable system guarantees success. The truth is, a strategy only works if executed consistently. Emotions like fear, greed, hope, and regret often destroy a well-planned trades. And also, mindset shapes your discipline, patience, risk management, and decision making. In short, your mind is the most important tool in forex trading. Key traits to a long-term success mindset in forex trading. Number 1 is patience. Wait for high quality trade setup instead of chasing the market. Understanding the consistent profits take time, and also avoid impulsive trade driven by boredom or FOMO, meaning fear of missing out. Patience allows you to trade selectively and maintain control. Number 2, discipline. Following your trading plan regardless of emotion or market noise. Respect the stop loss and risk limits, and also avoiding overtrading and reverse trading. Then discipline ensures consistency, which is the backbone of long-term profitability. Number 3, acceptance of losses. Losses are inevitable in forex trading. Accept them as part of the process instead of reacting emotionally. Learn from losses to improve strategy and execution. Handling losses with composure protects your capital and mindset. Number 4, focus on process, not outcome. Measure success by adherence to your rules, not individual trade profits. Avoid obsessing over daily gains or losses. Long-term growth comes from repeatedly executing your plan correctly. Focusing on process builds confidence and reduce stress. Number 5, emotional control. Greed, fear, hope, and regret can sabotage trades. Practice mindfulness or journaling to manage emotional response. Respond logically to market conditions rather than emotionally. Traders with emotional control make smarter decisions under pressure. Number 6, continuous learning and adaptation. Make market evolve and so you must approach. Review your trades regularly to identify mistakes and areas of improvement. 3, stay updated with economic news, market trend, and trading psychology. A mindset of growth ensures long-term survival and profitability. Practical steps to develop a long-term success in trading, which are a long-term success mindset. Number 1, create and follow a trading plan, include entries, exits, and risk management and trading schedules. Stick to them without deviation. Number 2, maintain a trading journal. Record trades, emotion, lesson, and decision. Review weekly to reinforce positive habits. Are you getting me? Number 3, set realistic goals. Focus on consistency and risk management rather than chasing quick profits. Small steady gains compound over time. Number 4, practice patience daily. Avoid trading just because the market is moving. Wait for setup that meets your criteria. Number 5, control emotion. Use deep breathing, meditation on short breaks after losses. Avoid the revenge trading or chasing losses. Number 6, embrace continuous learning. Learn from mistakes and success equally. Adapt your strategy and mindset as the market changes. Are you getting me? Let's continue. The benefit of a strong mindset. Are you getting? The benefit of a strong mindset. Traders who cultivate the right mindset experience 1, consistency, steady account growth without emotional spikes, resilience, ability to survive losing streaks and market volatility. Are you getting me? Confidence, trust in your trading plan and decision. Number 4, longevity. Trading becomes a sustainable long-term activity. Number 5, reduce stress. Emotional stability reduces burnout and anxiety. Mindset transform trading from a risky gamble into a disciplined professional business. So in conclusion, long-term success in trading is less about finding the perfect strategy and more about mastering your mind. Here is the key takeaway for developing the right mindset. Number 1, be patient and disciplined. Number 2, accept losses as part of the process. Number 3, focus on process over the outcome. Number 4, control emotions and avoid impulsive decisions. Number 5, commit to continuous learning and adaptation. Then, a strong mindset is the foundation for consistent profit and emotional resilience and a long-term successful trading career. Remember, the market does not control your success. You do. Cultivate the right mindset and long-term success will follow you. So in all this, you need to have a strong mindset, and you need to have a positive mindset, and you need to control your psychology in order to be a successful trader in this business in a long term. So if you have watched this video up to this moment, I have come to the end of this course. So it is a very, very lengthy course. Please make sure to subscribe to my YouTube channel, and also comment down below, ask me any question, and also like this video, share it to all your friends, and I will see you on my next video episode. Thank you if you have watched this video up to this moment. Thank you for sticking around, and I will see you on my next video episode. Thank you, take care, I love you guys, and bye for now. Hello guys, welcome back to my episode 10 on my continuation on the full forex trading tutorial course. So this episode 10 will be the last video on my full forex trading tutorial course. So in this episode 10, I will be teaching you guys the following things. Are you getting my point right now? So in this episode 10, I'll be teaching you what are forex brokers and their platforms. Understand? That is the first thing. Then I'll be teaching you types of forex broker. Are you getting me? Then I will be telling you the brokers regulation and licensing. Then I will be telling you the trading platform, which is the MT4 and so on and so forth. Then I'll be telling you the other types, the execution types, and spread, commission, and swaps. So if you have watched this video up to this moment, please make sure to like this video, make sure to subscribe to my YouTube channel, and also comment down below if you have any single question concerning this video. I getting my point, because I'll be breaking everything down for you from the beginning to the end. So if you are ready, I'm ready. Let's continue. What are forex brokers and platforms? So forex broker are organization or people who facilitates your trading. I getting my point? Yes. Forex broker are people and organization who facilitates your trading and make sure that execute your trading whenever you place your trade. Are you getting me? So forex brokers are people who are among the top participants in the foreign exchange market or the foreign exchange business. Are you getting my point? So that is it. So, and you have to register with a broker for you to have access to the trading and the global currency platform. Are you getting my point? So you have to register with a broker. A brokerage firm helps you to register and facilitate your trade, and also make money when you trade, and also withdraw your profit whenever you make profit. So, and also they have different brokerage firm platforms. Are you getting me? So it depends on the kind of platform that you want to choose. So they have different brokers available on the internet. So I will not be the one to recommend those brokers for you. You have to make your research. Are you getting my point? Once you make your research, then you check out your desired broker and know the broker that suits you. Are you getting my point right now? Let's continue. Number one, we have different types of brokers. We have different types of platform. We have the Xness, which I personally use. I make use of Xness, but don't use this. Make sure you do your own research first before you make use of it. Are you getting my point? Make your own research first before you make use of it. I'm making use of Xness. Are you getting my point? So if you like to make use of Xness, you can go check it out on their platform. Do your own verification then. You can partner with them. Also, we have a IC market. Yes, of course, we have the IC market. IC market is also a very good brokerage firm that helps you, to facilitate your trade. I get my point. So and so many other brokerage firm. So I'm not mandating you to make use of my own brokerage firm. No, you can choose any brokerage firm of your choice. So we have different types of brokers. Let's read the second part. Types of brokers. We have different types of brokers. Number one, we have the ECM brokers. Are you getting me? Yes, we have the ECM brokers. The ECM brokers are the people are one of the the minimum type of brokers. What they normally do is that when you send your order, they route your order to the market makers. Are you getting me? So when you send your order to the ECM broker, because they will get their price from the market makers, and then they will route it back to them within some few milliseconds. Your trade has been executed. Are you getting my point? So that is all about for the ECM brokers. Then we have the STP. Then we have the STP brokers. There are also people, the type of brokers that that execute your trade more faster than the ECM brokers. Are you getting my point? So we have the market makers. Market makers brokers are the type of brokers that execute your your trade almost instant. In fact, not almost instantly, within some few milliseconds. Are you getting my point? Because you are not trading directly with the market maker. When you send the order to the market maker, they give you the instant price of what the market is saying. Are you getting my point? So then let's talk about the brokers regulation and licensing. So my recommendation is this: before making use of any broker or before trading with any platform, make sure that that they are regulated, and also that they are licensed. I am making my point now, because there are so many scam brokers out there on the internet trying to scam out people of their hard-earned money. So before you make use of any broker, go to their terms and services. Yes, I'm telling you for free right now. Go to their terms and services, check out if they are regulated. Are you getting my point? So if they are not if they are not regulated, my brother, don't make use of that brokerage firm. No matter how they advertise it, make sure it is under regulated. That is number one. And also it is licensed by regular bodies. So any brokerage firm that you log into and it does not have this name of this licensing organization or regulation company, my brother, stay out of that platform, because that platform is fishy. If they don't have the FCA company that are being regulated under them, if they don't have the Cyprus SEC, if they don't have the ASIC, and if they don't have the NFA, etc. But these four major ones are the major four regulatory bodies and licensing bodies that make sure that all the brokerage firms who are having access to the global financial market instruments are regulated. So make sure that before you join any platform or before you register any broker, go to their terms and services and go to their regulatory bodies. Make sure that they have this FCA. Make sure that they have Cyprus SEC. Make sure that they have ASIC, and make sure that they have NFA. Are you getting my point? So even if you don't see the four of them, at least you must see at least one. That shows you that the brokerage platform is regulated, and they won't run away with your money. Are you getting my point right now? So it is very, very important for you to check out the regulatory ratio and regulatory rules and regulation guiding brokerage firm. That is it. Let's continue. Then let's talk about the trading platform. So the trading platform, we have different types of trading platform. Are you getting me? We have the MT4, we have the MT5, we have the C Trader, and we have the Trading View. So what is MT4? MT4 means MetaTrader 4. MT5 means MetaTrader 5. Then we have C Trader and we have Trading View. So let me explain one of them after the other. MT4, which is MetaTrader 4, is a trading app or trading platform that gives you access to your trading account login, where you can place and buy trade. The same thing as MT5. I got me. And then this MT4, you can get it on your Google Play Store if you're making use of an Android. And this MT5, also you can download it on Google Play Store if I'm making use of Android. If you are using an iPhone, you can also get it on your Apple Store. Are you getting me? So these are the two apps that you will be using to execute and analyzing your trade directly with your brokerage firm. Because you can't trade, you can't place trade in your broker account. No. When you register with your broker, then you open a trading account. Then they will send you they will send you a login details that you use to enter it on your MT4 or either MT5. Then once you log it, then the money that you deposited in your brokerage firm will appear on your trading account. Are you getting me? So that you can begin to buy and sell any currency or any assets in the financial markets. Are you getting my point right now? So let's continue. Then we have the MT5. MT5 is the second trading platform. Some brokerage firm make use of MT5. Understand why some make use of MT4? So if you register with a broker and you do not see the MT4, then you will see the MT5. So MT5 is also similar to the same thing that I tell you, just that the MT5 app have more advanced features than the MT4. In MT5, you can see how much you are risking in your stop loss. I get my point right now. So that is the difference between the MT4 and MT5, because MT5 is a bit advanced. I get my point. So then let's continue. We have CTrader. CTrader is another trading platform. Some brokerage firm are making use of the CTrader. So CTrader is another trading platform where you can have access to the to the financial market and also trade in the financial market. You can also register when you register with your trading platform, then you can also make use of the CTrader app. Are you getting me? But the most popular ones that people all over the whole world are using to trade are either the MT4 and the MT5. Then we have the Trading View. Trading View it also have an app or also have a website. So, but mainly Trading View is not a a trading app where you can place trade. No, Trading View gives you access to all the global financial assets that are being traded on in the financial market. In the Trading View, you will see all the whole assets in the whole world. So you will see the crypto, you will see the stock, you will see the indices, you will see any tradable asset. All of them are available on your Trading View. Are you getting me? So when you open a Trading Views, you can be able to analyze the market, because normally tradingview.com is where most of traders analyze their trade. Are you getting me? So if you want to analyze your trade, you go to Trading View. Are you getting me? Once you go to Trading View, you can go to Trading View and analyze your trade and place your trade and execute your trade. Are you getting my point right now? So, but Trading View, they have the free version and the subscribe version. So you can make use of the free version as a beginner. Then when you get money, you can subscribe for the paid version so that you can have unlimited access to different tools and different indicators in the trading, and also have access to different charts. Because one thing I like the Trading Views, you can see the market from 1 minute up to let me say up to 2 hours, nothing. Sorry, up to 2 years time frame. Are you getting me? So tradingview.com give you more access, to the global financial asset, from the cryptocurrency to the currencies, name it, whatever asset that you're looking for to trade, you will see all of them in the Trading View. So what Trading View normally I do with Trading View is that I analyze the market with Trading View. Once I analyze the market with Trading View, the next thing I have to do is that I will then go and place my trade in my MetaTrader 4 from what I analyzed in the market in the Trading View. Are you getting my point? So you can go and check it out for yourself at tradingview.com, or you can download their mobile app on Google Play Store if you are making use of an Android, or you can also download it on Apple Store if you are making use of an iPhone. Are you getting my point right now? So let's head over to the next subtopic, which is other types. So in the forex market, you all know that we have different type of market orders. Are you getting me? We have different type of order types. We have the market order, you have the limit order, we have the stop order, and also we have the trailing stop. So market order is or you can call it instant execution. Instant execution is that when you place your trade immediately, whether it is a buy or sell or a sell trade, the moment you place it, then you'll be given a trade immediately. Are you getting me? So that is a market instant order. Then we have a limit order. Limit order is an order that you send to your broker, telling them that that you'll be taken out of this particular trade when you are done. That is a limit order. Then we have stop order. Stop order is more of is what you call stop loss. So stop loss helps you to be taken out of the trade when you have this amount of money that you are willing to risk in the market. That is what you call stop order or stop loss. Are you getting me? So we have we have trailing stop. trailing stop is an order that you send to your brokerage firm whenever that you want to protect your profit. So it's what you call you are trailing stop, as in you are trailing your stop, meaning that you remove your stop loss from the original place that you place it, and break and put it inside profit. That means now you are trailing down your stop, and now you have already protected your profit. Right now you are running on a risk-free trade. Are you getting my point right now? Then we have execution types. So we have different types of execution types. We have instant execution, we have market execution, and we have pending orders. So instant execution is that the moment you send out your trade, whether it is a buy trade or your sell trade, your brokerage firm will execute it for you immediately. So pending orders are the orders that you put in pending when the price of an asset you are targeting to reach is a particular price before it can activate it for you automatically. Then you put your stop loss and take profit. Then let's talk about these three things: spread, commissions, and swap. So the difference between the bid and ask is spread. Understand? So spread is the difference between the bid and ask. So this spread is more of is what a broker takes from you, for facilitating your trade. Are you getting me? So this spread is more of like a broker's commission. Are you getting me? Yes. Spread is more of like a broker's commission. This is what a broker takes from you for facilitating your trade for you. Are you getting me? But it is not a too much amount of money. It's just a little amount of commission that a brokerage firm takes for you. Then we have commissions. So commissions are what and ways the brokers make money. So brokers make money from commission, from trading commission, especially if you are from a tax-based country. After making profits and after trading, they will collect. You have to pay tax from you, and then once you collect the tax, your broker also collect commissions from you. Then before you can withdraw your money. Are you getting my point right now? So also we have what you call swaps. Are you getting me? Swaps is more of people who are into swing trading. Are you getting me? So if you're into swing trading, you understand what is swaps. Swing trading are type of traders who keep their trade that can run from ranging from 2 days, 3 days, 1 week, some even a month. So every day that your trade is on the trading platform of brokers and it gets to the next day, your broker will charge you what we call swap fees. Are you getting me? So any day that your trade enter the next day, your broker will charge you what we call swap fees. So swap fees are what your broker charges you whenever your trade enters the next day. Are you getting me? So you are paying for swap fees for them still facilitating that your trade and still leaving your trade to keep running. So even if your trade run for like 3 months or 1 month as a swing trader, they will keep charging you swap fees. Are you getting my point? Yes, because that swap fees is what helps you to keep that your trade to keep running on the market. Are you getting me? So that is it. So the next thing I want to chip in is, before this final course, is that be very careful and always remember that for you to be a successful trader, you need to control your psychology as a trader, because trading psychology is, let me say, the 80% of what will make you successful as a trader, and then 20% strategy. Are you getting me? So you need to be disciplined as a trader. You need to be disciplined. Make sure that you are disciplined. Are you getting me? Make sure that you are disciplined. Yes, of course. Make sure that you are disciplined. Please apply discipline in your trading so that you will last in the financial market. Are you getting my point right now? Yes, be disciplined. Be patient. Wait for your setup to come before you place a trade. And also avoid over trading. Yes, it is I'm telling you as a brother, avoid over trading. Yes, make sure that you avoid over trading, because over trading destroys your trading account. And also be patient, because there is an adage that say a patient dog is the fattest bull. Be patient. So avoid over trading, be patient, and also follow your rules. Yes, follow your rules. Yes, follow your rules, because forex, you need to approach forex systematically. Yes, Approach forex systematically and don't trade forex randomly. No, it doesn't make sense. So approach it. Have a rule-based system. It will help you a lot. Are you getting my point? So if I watch this video up to this moment, thank you for sticking with me up until this moment. Thank you for sticking with me, and I will be seeing you on my next video episode. Please make sure that you can be able to sit down and memorize everything that I teach you. Go and practice all of them one after the other. Are you getting me? For you to be able to grasp everything that I've already taught you in this course. Thank you for watching this video up to this moment, and I will see you on my next video episode. Thank you. I love you guys, and bye.